Hey, good morning, everybody. Good morning, Jonathan. You knew I was going to come in and do that. Thank you for the annotations. How we doing today, guys? How's everyone doing? Nice to have you with me here in class. Can you hear me okay? Feeling good? Good morning, Morgan. Hope everybody enjoyed the weekend. Hey, Rob, Luke, 371. Nice to see you. Welcome to the room. Malcolm's in here, still above ground. That's good stuff, Gary. That's good stuff. I was giggling at your post in the other room. No beer, no brats, no burgers, no fun. Good morning, Miss Jen. Nice to see you. Long weekend. Hope everybody's rested, ready to go. Good morning, Gerard. Gerard, did you get the picture that I sent you via direct message? We had so many audio problems that I didn't end up recording the one day you were relying on the recording. So I hope that made sense. Everything that I sent. So that's all right, Gary. You got to take care of yourself. We got to keep you around. You just got no sound. Can you guys hear me? Give me a Y if you can hear me. Please and thank you. Sometimes Discord in the morning, I don't know if it's everybody coming in at the same time, but sometimes Discord likes to mess with me a little bit. So, um, amen, Gary. So, guys, let's talk. We do have high impact or medium impact news right now as we speak. The S&P composite's going on, and then at 10 a.m. we're going to get that cheeseburger consumer confidence. So we do have a little news to break the markets out of their mold. Every morning I check news. Every morning I come to forexfactory.com/calendar, and I'm looking for those orange boxes and I'm looking for those red boxes, guys. And what it does is it lets me know that there is somebody with a lot of money that may be making an emotional response to whatever the news is. I personally don't trade news. I don't teach people how to trade the news. I don't create expectations of up or down based on what they say or what they're doing. The only thing that I do is I kind of sidestep the market and I say, you know what, things can get crazy here in a minute. I'm gonna watch and see what happens, and then once it goes back to kind of a normal pace, I'll jump back in. But I do this every morning, and this is really a huge advantage coming in because it keeps you from jumping in front of that emotion. Everything that I talk about, guys, and I mean everything that I talk about, is from the Nexgen page, straight from the trading guide. There are zero secrets. Zero secrets. Rob, what does nothing mean? All right, can guys give me a why? If are there people here that can hear me? Awesome. So if you have no volume, do that reboot. And guys, I'm going to do the same. I'm going to do the same right now. So I'll be right back. I'm going to do that quick reboot. All right, coming back. Let's see what we have. Hold on. All right, guys, I'm back. Can you hear me? Is that better with a little kill on it and then come back? Yep, okay, cool. I don't know why Discord likes to do this to me first thing in the morning. It's weird. It happens. Maybe it's the huge influx of people coming in, and then it tends to work itself out. Guys, everything that we talk about today is coming from the trading guide. Zero secrets. I don't have any desires to keep secrets from you. My goal is to give you anything and everything that you need. Good morning, Andy. So that you can find success. And guys, I'm going to tell you right now, And I'm going to say this from the bottom of my heart. There's an easy way and there's a hard way to do what I teach. The easy way is focus primarily on a high probability trade. Give yourself 30 days. By the end of the first week, if you really are keeping it simple, if you're keeping it focused, if you're only looking for this one trade, most people find it because we break it down into three little pieces. Gary, reboot. And we focus on a high probability trend trade first thing in the morning, guys. First hour every day, first class of or first lesson of the day is the high probability trend trade. And we do this because the high probability trend trade is when each indicator, every chart agrees for the trade, guys. Your triggers are the strongest, and we're going to talk about what it means to have strong triggers. There's no termination conditions in the way, and once again, we'll talk about what it means to have no termination conditions. And guys, there's just going to be nothing between you and your entry from the best to the best spot. And I focus on this high probability trend trade every morning, not because I want you to be stuck on this trade or not because this is the only trade that's available, but to be honest with you guys, this is the trade that turns you into a chart reader. And what happens now, awesome, Gary. And what happens is, and this is kind of funny, is trading, learning to trade is like, I don't know, running a marathon. And everybody shows up at the starting line and wants their trophy before they actually get the work done. And it's this weird phenomenon that's been going on for as long as I've taught this class. Everybody wants to be a millionaire in a week for whatever reason, and it just doesn't feel realistic to me. But if you keep it very, very focused, guys, if you focus on this high probability trend trade, if you give yourself the highest advantage every time you enter the trade, what we've found is that most people, through simplicity, can have a very simple plan that provides results, positive results, while they grow with the software. So we're going to lay down a foundation right now. Your goal is not to be a successful day trader in your first 30 days with Nexgen, but rather be a competent chart reader. Understand where the market is likely to continue, where it's likely to go, where it's likely to stop. And your chart reading is going to open every door that you could ever hope to have opened. And you're going to see patterns and advantages, and you're going to see all these things in the market real time if you keep it simple first, guys. And then when I talk simplicity, we're going to study a rule in the first hour here, or a trade that only has 3 rules. Each rule gives an advantage, guys, and it's the advantages that are your chart reads. Your chart read will let you know if you have strong triggers on a large chart, rule number 1. And that's the advantage of momentum, guys. That's having a market that's likely to push in the direction of the trend. That's having the strength that has the potential to break key areas. And momentum is really the advantage when you can recognize it at a moment's notice, that you'll notice in the room there's a lot of people that have trading plans built completely around momentum because that advantage is such an amazing advantage. Rule number 2 of the high probability trend trade says no termination conditions, not trading into areas likely to stop the market. As soon as you understand the recipe for termination conditions, we're about to talk about it, look at it, go find them, you'll never trade into an area that can create this big, ugly, violent bounce against you. And that's the advantage of a clear path. And then finally, when you have momentum and a clear path, and guys, these are the 2. These are the gold star winners. Because once you have momentum and a clear path, there's about 175 different ways to figure out how to get into the market, to take advantage of those 2 concepts. For the high probability trend trade, it's going to be a very specific recipe that minimizes your risk, that gives you the best of the best entry, and that's rule number 3. And these 3 rules, once again, guys, simplicity, I can't say it loud enough, are going to happen on only 2 charts. We're going to use a large chart and a small chart. Your large chart is going to be able, through the most current bar, define the direction, the momentum, and the areas that may be problematic on that large chart with that most current bar. It's a very slow-moving, broad stroke of a brush, guys, and it gives the overall opinion of the market. It lets you know what the large crowd wants to have happen. The large crowd has the money to create trends, and the large crowd has the money to establish momentum. The large crowd is who's making decisions at these key areas on the large chart. So following the large crowd is going to give you the advantage of momentum. It's going to give you that clear path that you need to have room to your targets. And then once we have those two advantages in place, you guys are going to let the small crowd do their thing. And that's your small chart. This becomes an entry chart. This is where you're going to refine that broad stroke of a brush. Your smaller, faster chart is going to break this one bar and all the action inside of it into about 15 to 30 bars. Excuse me. And this is where rule number 3 comes in. And really the small chart is like what the small crowd wants. These guys create little fluctuations and blips in the market. And you guys are going to be able to capitalize on it through rule number 3, establishing that entry area. So keep it simple, guys. We're going to learn the trigger line and Fibonacci rules for when it's okay to trade. I'm going to give you a very clear plan to take that high probability trend trade. You guys can simulate and practice and make sure that you're posting in the room and getting feedback on what it is that you're seeing, what it is you're doing. And what we're going to do is all the feedback that I give is going to revolve around your chart read. Are you reading your indicators? Are you looking at them and understanding those very basic concepts correctly? Because once you do, everything works out great. I'm going to encourage you guys to not practice the wrong trades, to really focus on having advantages. Lots of market replay pictures in the classroom today. Use market replay to practice your rules, right? Not to win a bunch of simulated money. It's so easy to get lulled into the trap of believing that simulator riches are real, right? People will hold these trades forever because there's no risk, there's no accountability. So practice the right rules, and then what happens is when you make the transition to live, you're more apt to follow your trading plan. And we're going to simplify, guys. I'm going to give you the high probability trend trade. I'm going to give you checklists. I'm going to give you a written plan, has pictures of the conditions. But you have to learn those looks so that they become easy. You've got to study them. You've got to practice them. So that's where becoming a confident trader ASAP, guys, the step-by-step path comes into play. The first thing is you've got to take pictures. You have got to take pictures. And if you go to the two charts, everybody was given capture software when they downloaded. So if you're brand new with me, we're going to do it together real quick. Open up your capture software. This is what your icon looks like. If you don't see that icon up there, you need to go to your search bar and just start typing in TechSmith, because this is, without a doubt, the most important part of everything that you're going to do as a student in my room. Every time you post a picture in the room, you're going to get feedback on what you see, what you did, your chart read. We're going to talk about your entries. We're going to talk about your exits. And we're really going to work together to make sure that you're reading the software correctly, that you're not taking unnecessary risks. If I see something that you could do better, right? Or I see something that may look good in the moment, but it's going to hurt that long-term success, we're going to talk about it. I am available 15 hours every week, live classroom, and my sole purpose in life is to get you guys to where you want to be. So do me that favor of posting in the room. So with your capture software, just mash on that big red button, and this is a click and drag tool, which means that you're going to click on your left mouse button and you're going to be able to drag, and that's how you're going to get pictures and how you're going to write on it. If I hover over just one chart, it's only going to give me one chart's information, but you guys are learning a two-chart scenario, so I want you to go to the upper left-hand corner and drag it all the way down to the bottom right, and then when you release that mouse, it's going to ask you, hey, you want to capture a picture? Right there, big camera. Once you do, it's going to give you what's called the capture, the image preview, guys. And this is just the picture that you just took. There's tools up top. You can change the color. There's an arrow, a call-out, shape. I've never really used the highlight, but I use this shape a lot. And if I click on the shape, it's going to create a box. Once again, I have to left-click my mouse. If I go to the bottom right a little bit, I get a little box. If I drag it way down, I get a huge box. You're going to use these boxes. Maybe you're focusing on something that you see on the chart, right? And you're like, hey, Mark, what's going on right here? Talk to me. 624, Ron. 624 is what I have. So yes, these arrows, you can do short arrows, click and drag once again, or if you extend it, so you can make these arrows go anywhere. And then most importantly is the call out box, guys. You have to left click and drag down. You'll see the cursor blinking. This is where we have a conversation, and I'm not typing well today, I apologize. This is where you're going to tell me what you see. If you took a trade, tell me why. Tell me what your chart read was. Show me both charts. Circle entries and exits. Not yet, Ron. Not yet. And guys, give me the most information that you can give me coming into all your annotated charts, because this is how we're going to have a conversation. And the cool thing is it doesn't have to be a trade. You could literally show me a chart and you can say, hey, Mark, is this significant, right? And that's all you have to do. Should I watch this area? And what this does is this opens up the door for a conversation on termination conditions. You can do this with trigger lines, and we can have conversations about strong trigger lines. You can come to the small chart and you can say, hey, was that an entry right here? Does that follow the rules? I'm a little unclear on them. Can you walk me through the process? And the answer is absolutely, guys. I always will. And the more that you post in the room, the more likely you are to get to where you want to be. And it's nerve-wracking to post in the room. But let me show you how easy it is. You ready? I'm going to hit copy, and I'm going to go to the chat box. Good morning, Miss Cindy. And there we go. I just posted in the room. And the cool thing is it doesn't matter if it was a winner or a loser. There's so much information on every chart that you post that the more you post, the more information you're going to get. And we're going to talk about everything that you see. You can tell me how you felt. You can tell me, I like it if you tell me your rules. And then next you can click on the upload button, and that's going to push that picture into the screencast cloud. And if you copy that link can also be put in the room. I'm a big fan of following the links. They usually come up nicer pictures. But the next thing you're going to do with that link, guys, whoops, I closed out my picture, is you're going to drop it into the spreadsheet that Nexgen gave you. So your spreadsheet has 4 tabs. The first tab is where you are going to drop every trade that you take. This is the trade tab. This is your trade journal. And you can put that screencast link in there, and it's going to talk about how you felt, whether it was coming from a good top or bottom, what the advantages were, and what happened. But most importantly, guys, is every time you post in the room, I'm going to open up your chart. And Jonathan dropped this in. He goes, hey, no trade yet. I don't have the best look here. This one just didn't work out, but I like the effort. And he's just kind of waiting for it to come together, and we'll have a talk about what he sees and why he sees it, and whether or not it was a good opportunity to take a trade. And I think that really that was a great opportunity, Jonathan. And when we talk about it, we'll go back and we'll talk about small triggers on a small chart, and there's going to be a lesson. And then Jonathan's job is going to be to take that feedback and drop it into his notes section, because he's going to come back tomorrow morning, and all he's going to do is he's going to open up that tab on the spreadsheet, and he's going to study what he did yesterday. Sorry, Jonathan, I'm using you for example this morning. And if you ask yourself what worked, well, then you're going to start to see these patterns. You're going to start to see these advantages coming together, and you're going to say, wow, every time I had momentum and a clear path, I seem to win easily. And when I forfeit those advantages, all of a sudden I find that I'm losing more and more trades. And guys, your rules give you a statistical advantage. You're going to find that the things that work tend to follow the rules. And they're going to feel easy, and you're going to stay relaxed through the trade. And then the things that don't work, this is where posting in the room is so important, guys, because you might think that you took the greatest trade ever with every advantage, and then upon a little study, and remember, I get to look at your charts with zero emotion, no adrenaline. I'm not amped up hoping to win a trade when I look at your charts. I'm just looking for advantages. Sometimes we can take it and pinpoint little things that can be corrected, that can get you closer to where you want to be. And you'll notice that when you're taking the wrong trades, when you're breaking rules, you will feel nervous. You'll start moving your stops a little bit. So stay connected to your feelings when you're trading. That sounds very hippie, I know. But you'll notice the adrenaline rushes when it's challenging. And you'll notice that you're like, oh my gosh, they're going to have to come get me if they want to take me out of this trade when you're doing it right. So, this little historical study each morning, it's going to prepare you for the day because you're going to be focused on advantages. And it's going to accelerate the learning because you're going to go back and you're going to begin to recognize these patterns that win more than they lose. Um, and this is a very underutilized tool by new users. The second tab of the spreadsheet, guys, is where I've taken the 3 rules of the high probability trend trade, and I've given you a section in green where you can take a picture of the individual rule, what it looks like, what it means to you. And there's also the red sections where the rules aren't met. And if you go through, and I'm going to give you a Word document that's going to allow you, it's going to give you a drill that you can do. If you go through and you fill up the spreadsheet with pictures, guys, pictures are how we learn. It's recognition through repetition. Well, then you're going to be able to recognize the first advantage by the end of the first day. And there's absolutely no doubt in my mind about that. And the recipe for those likely to stop areas is very consistent. And if you spend a little time studying termination conditions, rather than trying to make all the simulator money on day 2, um, then you're going to find that success comes faster. And the same thing with entries. So I'm going to give you a drill to fill this out. I'm going to give you everything that you need to be successful. It's going to be up to you to do it. The next tab is your favorite looks section, guys. This is where you're going to build a trading plan. This is where first you're going to take pictures of high probability trend trades. We're going to talk about how to study that and make it easy. And then you're going to begin to manage those trades, and you're going to start to see patterns, and you're going to understand termination conditions. And my goal for each and every one of you is to make your favorite trade section look like this client trade section. This is where I've taken pictures from the room. This is where we've taken perfect high probability trend trades, medium probability trades, annotated charts that you can go back and study. And you can begin to commit these to your memory. What it looks like when the market isn't moving, to have the absolute best of the best, that recognition makes it easier to find these trades when the market is moving, when you feel like the pressure's on. There's a whole section on management and patterns, guys, and I've given you entry sequences for the highest probability trend trades, both long and short, very mechanical management. But if you use that spreadsheet every day, guys, and you come back and study it, and you take those pictures every day, and you drop them in the room, then you'll be on the exact same path that the people that find success the quickest with Nexgen are on. The more you fight it, the more you say things like, well, I don't want to post in the room because what if I'm wrong? I need you to be wrong because then we can correct it together. And one that I get a lot too, and I kind of felt the same way being John Novak's brother, is I didn't want to post in the room and feel like I was, putting a monopoly on the time. There's no such thing, guys. I've been teaching this classroom for 3.5 years, and I've never had somebody annoy me with questions. I've never thought, man, I wish Jonathan would quit trying to be a better trader. Or, gosh, for the love of fuzzy, will Troy just learn it on its own and not come to my class where I'm paid to teach him to learn this? So, guys, drop it in the room and ask your questions, but just do me a favor. Annotate your charts. If you want to show off, and guys, I love it when you show off. Write on your chart, give me one look and go, man, this was my long, this was my entry, this is my exit, this felt good, right? I don't need feedback, Mark. I'm just showing people what can be done with this software. And I love those posts, and I always want to see those posts. But this is your path, guys. Embrace it. Embrace it, embrace it. We're going to go through and we're going to start with a high probability trend trade. I am giving you, and guys, I'm going to say this pretty cocky right now. I am giving you the greatest tool that there is in trading. You're getting the software that's going to give you the ability to recognize highs and lows and when you should be trading to them and from them. The only thing that I can't give you, the only thing, Ron, that I can't give you is experience. So if you've come to me and you're brand new, I want you to be cool with that. I want you to say, hey, you know what? I'm new. There should be zero pressure on me to be any good at this in the beginning, guys. Um, for those of you that have been here a while, you know that I'm trying to be a golfer. And guys, I suck. I'm so not good at it. And I get a little better every day. But I love it because I know where I'm going. I have a plan and I'm willing to work for it. And trading is very much the same way. Learn the process, learn the mechanics, and you'll find that the results tend to follow. So we're going to talk about the high probability trend trade, guys. Those use Boy, I tried to play Sunday. I have been 100% laid up on my back. My second shot blew my back out. It was horrible. I had to ride 9 holes, barely able to stand up to get back to the clubhouse because I'm stubborn. Large chart, guys. Large chart leads the way. Must have strong triggers. So let's talk about strong triggers. And for those of you that are brand new, I want this to be your lesson for the day. I want you to not focus on being rich with the software or finding trades. If this is day one, I want you to do one thing for me. I want you to understand that strong triggers on the large chart leads the way, that this is your first advantage and probably the easiest to recognize advantage. So when the background on your large chart is green, the market is going up. And the highest chance of success for the brand new user is to go up with it. And if the background on the large chart is red, it's going down. And once again, the best chance of success is to go down with it. So rule number 1 says large chart must have strong triggers. In order to have strong triggers on the large chart, both the small triggers, these solid lines, these are moving averages, and the large triggers, the dashed lines, they both have to be green too. If your trigger lines don't match the background color, you don't have strong triggers. It's really pretty easy that way. And then strong triggers means that there's a separation between the small and the large. So both triggers are green, both triggers are up, both triggers are wide, and there's this gap between the small and the large. It looks like scissors that are opening, right? In a downtrend, everything's red. The small's below the large, and it looks like scissors that are opening. Guys, when those scissors are open, when there's separation between the small and the large triggers, you have a strong trigger line. And when you have strong triggers, the odds are favorable for the market to continue up in an uptrend, and the odds are favorable for the market to continue down in a downtrend. And we're just going to call this odds favorable momentum. And guys, you're going to see it all day long on people's charts. OFM, odds favorable momentum. Guys, this is the look that pushes that market up, and this is the look that pushes that market down. This is the look that can break key Fibonacci areas, that can get that price through those key areas. And this is even the look that will cover some of the mistakes that new users tend to make with the software. So let's go to a large chart real quick, and let's just look. And I want you guys to see, man, great termination condition lesson here. Let's get past the holiday. In an uptrend, small's above the large, larger wide, angle to the direction of the trend. Guys, when you have this look, this is the best of the best time to use that smaller, faster chart to buy Fibonacci support. And on your large chart, it's going to look like one of these tails or a wick. This is that pullback on a smaller, faster chart. In a downtrend with that momentum, you're going to see that tail or the wick. You guys are going to be able to pinpoint exactly where that tail or that wick is most likely to form. But I need you guys to do me a favor. Give me a Y in the room. If you see it, small's above the large, large wise. Guys, this is the easiest lesson that you are ever going to get. And let's do this. Let's pull up our capture software and let's take a picture. And once I take this picture, I'm going to draw an arrow to this look right here. And I'm going to use that call out button. I'm showing you guys how to study, how to get to where you want to be right now. Smalls above large, all green and wide. This is strong triggers. This is momentum. This is rule 1 met. Does everybody see it? I described the look. right? I said what that look meant to me, what the advantage is, and what rule. Nope. So, Daryl, what's awesome is you don't have to overthink it. When these smalls separate from the large, that's strong triggers. Don't even worry about the bars. Only focus on the triggers. Um, and it'll take a lot of the pressure off. What is the perfect spot for the midband? Right in the middle, Jonathan. I'm not sure I understand the question. Midband's just a moving average. It's just gonna go right through the middle of your screen all the time. If price trades above it, it's going to be green. It'll probably behave as support. If price trades below it, it'll be magenta. It can act as resistance. But we're not even worried about the midband right now, guys. The only thing that I want you understanding is the look. We'll get that in termination conditions. So take those pictures, guys, and copy that screencast link and go to your spreadsheet to that 101 and drop it in there. And what you're doing is you're creating recognition through repetition. Strong triggers up. And now I can come back tomorrow and I can look at these strong triggers up, and when I'm looking for rule number 1 to be met, I don't ever get fooled. I know exactly what it looks like. Smalls above the large, both are wide, both are angled in the direction of the trend. Guys, this is a market that has the potential to continue up with momentum, and that's rule number 1, perfect right there. But rule number 1 isn't a forever thing, guys. Strong triggers are the best of the best, but they weaken. So as price continues down, you'll notice that the small triggers work their way inside of the large triggers. This is the first sign that they're weakening. Let me get my laser pointer on here. Pew, pew. And then when the small triggers work inside of the large triggers, this is what we call a weakening of the large triggers. And when I have weak large triggers, when the smalls are on the inside, guys, this lets me know that anything can happen up or down. Luke, do me a favor. Go to your search bar and type in TechSmith. And then I'm going to get you too. Thank you for posting that in the room. Here's the link. Literally a 45-second download. It should be on your computer with the load, and it'll come up TechSmith Capture. I'll give you this big icon. But if you don't see it, or you don't even want to look for it, just click the link. Get that download. It'll take you just a minute or two to make it happen. Super easy, man. Guys, weak triggers, smalls inside of the large, anything can happen. Listen to the language. Space between the two, scissors are open, wide, odds are favorable. These tails are where you're going to be able to pinpoint entries on a smaller, faster chart to reduce your risk, to ride that wave of momentum. So it's not a forever deal. Strong triggers turn into weakening triggers, and there still may be options when you're a little more in tune with your chart reading. Anything can happen triggers completely forfeit the advantage, but you're going to get to a point where you're so comfortable with patterns that you may be able to capitalize. Your ability to read charts is going to allow you to manage aggressively. And guys, when these anything can happen triggers hit an area, these areas are more likely to hold. Remember I said strong triggers can break key areas. Weak triggers tend to not. They create untradeable bounces. Even if the market is going to continue, without that advantage of momentum, we see these areas hold more often. And that's kind of our segue to rule number 2. Also on the large chart, making sure that you're not trading into an area that's likely to stop the market, one of those termination conditions. When there's none present, then you will have room to your targets. And that means that you have the advantage of a clear path, and that means that your second rule is met. So when we talk termination conditions, and then Jonathan, this is going to answer your question as well. I'm going to do this 2 ways. First, I'm going to show you guys a picture of, actually, first I'm going to show you guys these. Termination conditions, guys. It's a Fibonacci-based indicator that may reverse the market based on a comparison of the area and the trigger lines, the same trigger lines that give you momentum. So we're going to look for blue Fibonacci support, red Fibonacci resistance, divergence high and low lines, yellow one-to-ones. All of these are just lines on a big chart, guys. All of these are places where the people in control are making decisions, where the people that move the market might be entering, might be exiting, and the software does a ridiculously good job of calling these areas, and you're going to be able to do the exact same with your chart reads. So we're going to use the trigger lines when price reaches these decision-making areas, and you're going to understand whether these areas are likely to stop the market, whether they have the potential to break, or whether or not they've broken. And there's a pretty simple recipe to understand these two concepts, or these three concepts. The first thing that has to happen, and then this is the most important thing, is that price reaches an area, price breaks away, it goes off into the distance, whatever you want to say, and these dynamic Renko bars hit Fibonacci support. When they hit support, the only thing that you have to do is ask yourself, where are my trigger lines? If your trigger lines remain above support, support is likely to stop the market. That's it. It's that simple. You've reached a termination condition. No more short trades into the area. And then when both your small triggers and your large triggers, notice that I didn't say price bars. Moving to San Diego? Huh, I love San Diego. Can it have a safe move? Go play Torrey Pines. And I'm recording everything, so watch it. Watch it. Go to La Jolla and look at the sea lions. So guys, if price reaches the area, triggers remain above, no more short trades. Your brain is going to tell you, go short, it might break. Your brain is going to say, what are the chances this is going to stop the market, right? But your simple rules say if price reaches an area, the triggers remain above support, below resistance, no more trades into that area. Once your small triggers and your large triggers get to the other side of an area, in this case it's support, support's broken. And once you break an area, once the small and large get to the other side, that area is broken. Support becomes resistance, and you have a clear path until you reach that next area. And then the process starts over. So every time you hit a line, you have to go through that process. So price reaches support, no triggers, no trade. Small and large get through the area is broken. Let's look for odds favorable momentum. Let's look to sell Fibonacci resistance, pinpoint where that tail is likely to form on a smaller, faster chart. And then there's a third option, guys. And this third option is going to take you out of the realm of high probability trend trades. This is going to be your second trade. I will give you a plan for it, but it is 100% dependent on you understanding that no triggers means no clear path, and that both triggers mean that the path is clear. This third option is what we call a 50-50 trade, because 50% of your trigger lines will break through the area in question, but your large triggers, the other 50% of your trigger lines, haven't made it through. And we know that the recipe for a broken area is both small and large. So what this means, when the small smash through, when the large lag behind, and it's key that you have odds favorable momentum, because odds favorable momentum can break areas. Guys, the 6980 area has the potential to break, but it's not broken yet because the large haven't cleared, which means that it's only potential, which means that it's not a clear path, which means that rule number 2 isn't met, which means that you're going to rely on your ability to read charts to make sure that you have the perfect entry to capitalize on this look. But for brand new users, the safest path is let it be black and white. Let it be not broken or let it be broken. And once again, I want to go straight to the live market. And I want you to see a couple things here. And this is kind of cool. Doing this is going to help you build trust in the methodology, guys. None of the triggers broke through resistance, and look at the bounce, right? You even had odds favorable momentum going into it, but when it reached resistance, the trigger stayed below, no more long trades, and sure enough, it keeps you out of a loser. Same momentum to the downside, it hits these yellow one-to-ones, the trigger lines remain above, and off it goes into the distance. And when it reached resistance the same way it did here, you said, wait a minute, I'm not sure what's going to happen. And this area does have the potential to break, but it's still not broken, and we're not sure what the outcome is going to be. But those are one-to-ones, almost to the tick, and the market pushes up. Divergence high line with no triggers through it, untradeable bounce. Resistance breaks, behaves as support. Support holds and pushes the market back up. Guys, you have 10 days worth of data. And I'm telling you right now, if you scroll back and you see how often these rules for termination conditions stop the market, create a bounce, what you're doing is you're developing this trust, and you're saying to yourself, you know what? Even though they can break every now and then, usually with strong triggers, I've scrolled back and I've seen these things hold the market so many times, look at it again and again and again, that I'm not willing to forfeit that. I'm not willing to trade into these areas, to hope that they break, to wish that they break, to want them to break. I'm simply going to sit on my hands and I'm going to say to myself, I'll wait a second. I'll wait for that clear path. I'll wait for the best of the best. So is everybody cool with it being pretty simple? Price reaches, no triggers, no trade. When the small and the large break, the path is clear. And then we're going to work you into the potential. And guys, I always ask if people are good with it, because it's important to me that you are okay. And I have absolutely no reservations about slowing down the class, stopping the class, and focusing on making sure that you're comfortable with what we're looking at. I'm going to give you guys a couple pictures here. These are termination conditions at a high and termination conditions at a low. So you can take these, put them in your spreadsheet, study the look. The recipe's written out on it. This next picture is your friendly reminder that 90% of your day is going to be spent reading indicators, guys. 90% of your day is going to be spent waiting for advantages. And if you keep it simple, you're going to hear me say that a lot. If you keep it simple, it's going to be difficult for you to get caught taking this short into one-to-ones that absolutely no triggers broke. And it's going to be darn near impossible taking that long into resistance with all the triggers below it if you're really following these simple rules. And when the trigger lines don't match one another in the background, you're going to say to yourself, I don't have the advantage of momentum, and I still don't have a clear path. And man, this market isn't giving my rules met. And guys, this is your 90%. And this is a termination that I'm going to show you right here. If price ever reaches a mid-band and your large triggers remain a full bar away, this is the only time that a mid-band behaves as a termination condition. So this is what we call the gap theory. If price reaches a mid-band, and guys, this was right there on your lineup, the large chart mid-band behaves as a termination condition if the large triggers remain a full bar away. So if we hit this mid-band and the large triggers are way down here, we're not going long into this area. This is an area that may stop the market. So you really end up with about 45 minutes of no rules met. And when you have no rules met, guys, you have two options. You can break your rules and hope, or you can follow your rules and it costs you absolutely nothing to do nothing. And then what happens, though, is when this 90% shakes itself out, you begin to notice that the smalls are outside of the large, and you're like, I know this look. This is a good look. And you notice that the small and large triggers are above resistance, and it's behaving as support, and you're like, hold it. Rule number 1 is met, and rule number 2 is met. And you're going to say, man, let me use that smaller, faster chart to pinpoint exactly where this tail is most likely to form, and let me ride that momentum right up to the next key area, and let me get paid up there, and let me take the easy trades, the high probability trades, the trades that provide a statistical advantage. And if you can work that patience bone, guys, if you can do nothing when there's nothing to do, well, then all the profits stay in your account. But if you begin forming opinions and give away $500 breaking the rules, or giving away $1,000 breaking the rules, or just blowing out, right, breaking the rules, then this 450 becomes pretty insignificant. It's just digging you out of a hole that you created for yourself. So adherence to the rules, guys, is designed to keep you safe as a brand new user. These blanket rules, not trading in determination conditions, are designed to optimize your chances of success waiting for areas to break, insisting on momentum. All of this gets you to the point to where you can look at your chart and without hesitation begin speaking in terms of advantages. And you will take these advantages and turn them into different trades. I promise you. I've seen it happen with every person in this room that's been with me for longer than 3 weeks. But we're creating this foundation right now, this best of the best look to make sure that you have the highest chance of success. So is everybody good? Large chart lines can be problematic. Large chart lines need to break rather than trading into them. Large chart lines are where the people in charge are making decisions, guys. Can you give me a why? My newer people, Jeffrey Deans and Luke's and Daryl's, Parker, good to see you in here. Is everybody comfortable with this very simple concept? If price reaches and the triggers don't break it, let's just practice sitting on our hands. Let's practice waiting and really just kind of saying, man, I don't know what the people in charge are going to do, so I'm going to wait a minute. Well, on these large charts, guys, sometimes they don't reach the area. Sometimes the market's going down, the path is clear, you're looking for a short, and then it just kind of reverses from nowhere. And the same thing happens at highs, guys. They don't always make it to their target, not on the first push. This final termination condition is the only time on a small chart where I will say that rule number 2 is not met, guys. And it uses the idea of divergence. And divergence is defined in the dictionary pretty much a disagreement. So divergence is a disagreement, which means that if price comes down and goes up, we call this a pivot. And a pivot just means that the market changed direction. It doesn't mean it's a forever trend change or anything like that. It just means it went down and up, right? Price comes down, price bars come down, price bars go up, price bars come down, price bars go up. It does this all day long. Well, one of the things that can happen, and let me use a different color for it, we'll go yellow. If yellow represents the momentum of the market, and momentum doesn't follow, so price is pushing, but momentum is lagging, and this is done with calculations behind the scenes. Right about the third bar up here, after the pivot forms, it requires the pivot to do it, you're going to see a negative number and a cyan line. That's it, man. Daryl, that's brilliant. The department head always said, if something happens, take your immediate actions, then sit on your hands. Don't feel compelled to make it worse. I saw a video my brother sent me of Elon Musk saying that engineers always try to optimize something that shouldn't exist in the first place. And traders are very similar to that, guys. We try to make something out of nothing or something that shouldn't even be there, try to get blood from a stone, when we really can keep it simple. So price goes down, price goes up, momentum doesn't follow, and you see the cyan line from a low, you see the magenta line from a high. You also see that negative number. Guys, the negative number is a byproduct. It's a byproduct of the calculations. So 20 isn't better than 10, and 10 isn't worse than 50. It's just a byproduct. But what we know is that momentum was lost. GWC, he sent me a little Elon Musk thing, and Elon Musk was talking about engineers. And he goes, engineers are constantly trying to optimize things that should have never existed in the first place. And that's very much like trading. When your rules aren't met, guys, you're going to take trades. You're going to break your rules. Everybody does at some point. And then you're gonna hold on for dear life and try and get the absolute most out of a trade that you shouldn't have been in the first place. And it typically results in much bigger losers. So like Daryl said, guys, when you get the rules met, take your action. And then when they're not met, sit on your hands and wait for them to be met again, is basically what he said. So guys, 3 losses of momentum in the same price range may terminate the trend. It might, it could, it's not guaranteed to, but if I see 3 of these on a small chart, I'm not going short. If I see 3 of these on a small chart, I'm not going long. This becomes more powerful if I have those anything can happen triggers. Those small triggers work their way inside of the large triggers. So 3 divergences may stop the market. 3 divergences with weak triggers may stop it a little more powerful. And then if that third divergence is higher than the lowest, or lower than the high from a high, it creates a head and shoulders pattern. It just adds fuel to the fire. You guys will see this look, these three divergence on a small chart when maybe the large chart, that slow moving chart, can't give you the information that you need fast enough to tell you that change is coming. So your large chart read might be odds favorable momentum and it might be clear path, but then your small chart, those fluctuations on the large chart, you see three divergences, guys, you can pump the brakes and you can say, wait a minute, rule number 2 isn't met because of the three divergences. I'm not taking this long. And when that market tanks down, you're feeling pretty good about the money that you didn't spend. So, guys, that's rule number 2. And rule number 2 is a large chart rule except for those three divergences. And once again, man, I want to do this. I want you guys to see this because I want you to learn to believe this. Whoops. Go back. That's the small chart. Hold on. It's making my life difficult here. Oh, you know what? I just closed out my large chart. All right, I'm going to show you guys a trick real quick, and then we'll get on to entries. If you ever accidentally close out your large chart, go to your workspaces and just close the workspace, but don't save it. Click No, and then when you open that workspace back up, boom, there's my large chart. Pretty cool, right? Easy way to save yourself if you ever X out. So let's go to rule number 3. And once again, I'm going to ask, guys, you're not going to be a pro at this on day 1. You're probably not going to be a pro on this in day 2 or 3. It's a lot of information coming at you. If you keep it simple, if you allow your trade as a brand new user to be nothing more than the advantage of momentum and that clear path in the entry area, guys, you can focus on a trade that typically wins 70 to 80% of the time. You can take a trade that creates confidence through the memory of success. And that's why I keep it so simple in the beginning with these blanket rules. So large chart is going to say up. And the large chart is going to say clear path. And the large chart is going to say odds favorable momentum. So now we're going to turn our attention to the smaller, faster chart. Now we're going to let that small crowd do their thing, guys. And rule number 3 says that you're going to use a limit order to buy or sell a pullback in an area inside of favorable large triggers. We're going to refine that broad stroke of a brush, and we're going to be so stinking good at it that we're going to pinpoint where the market is most likely to continue, and it's going to be at areas on the small, faster chart. Large chart areas could be problems. Small chart areas give us the bounce we need to continue with the trend. But the thing is we want them to be inside of trigger lines, guys. And we're going to talk about these, but if we say it in one breath, on the small chart, we're going to use a limit order to buy or sell a pullback, this little shove that the small crowd gives us. We're going to buy it at an area, fibs, midbands, yellow, 1-to-1s, and those areas have to be inside of triggers. And guys, this is where the precision comes in with what we do. Is you're going to be able to pinpoint so much where the market is most likely to continue. You're going to be able to know exactly where this tail is most likely to form, but you don't have to wait for a tail to form. You're going to take it in an area inside of favorable large triggers. And favorable large triggers, guys, there's 2 looks you're going to see with these triggers. And I like to go through this, and I'm not proud of it, but it took me about 3 years to come up with this realization. These trigger lines are moving averages, which means that price is going to always try to come back to these moving averages. There's a mathematical thing there. Iron Mike, in a perfect world, you'll find that everything matches. Are there exceptions? There will be exceptions as you grow with the software. But in order to take the best of the best, and the reason I say this is because there are 2 sets of triggers. There's synthetic, which are these stepped, and these are nothing more, guys. When I say synthetic large, they're nothing more than the large triggers from the large chart. And do you notice how price pulls away and then back to the large triggers? So we're going to use that phenomenon, and we're going to use both the synthetics and the large triggers from the large chart. And what this does is it shows me visually where I expect price to correct to, where that regression of the mean average is I think what somebody smarter than me called it. price tends to come back to triggers, guys, but triggers are like clouds. I don't expect them to stop the price. I don't expect triggers to magically make the market bounce. So we rely on areas inside of favorable large triggers. And the tighter that the large and the synthetic are, one on top of the other, well, the least amount of space there is for these areas to be within, guys. So if you're a brand new user, this is your best look. And then Iron Mike, notice how it's odds favorable momentum on the small chart. That can only happen if the small chart matches the large chart, because your smalls will be above the large. And the areas are inside, guys. And as these trigger lines, these correction points begin to split and splay, it makes it harder to understand. Is it going to go back to the large triggers? Is it going to go back to the synthetic triggers? You'll get to a point where you're willing to take these trades with this look, but brand new users, buy or sell a pullback at an area inside of favorable large triggers. It will minimize your risk drastically. It'll take a lot of the indecision out of where the market is most likely to continue. And again, we're not trading the tails. We are pinpointing where the tail is likely to form on a smaller, faster chart. So large chart, most current bar, I'm putting my pointer above it. The background is green, the large chart says up. So you know you're looking for rules to be met for high probability trend trades long. Small triggers are outside of the large triggers. There's space between the two. Everything is wide angled in the direction of the trend. Can you give me a Y in the room if you see how on this most current bar we have odds favorable momentum? Because you got to make sure that rule number one is met, guys. We're counting on this momentum to push the market in the direction of the trend. And both the small and the large triggers have cleared resistance. The area is broken. The path is clear. Guys, the market is trading right here where my pointer is. This tail doesn't exist yet, and I'm going to show you how that works in a live market. So what we're going to do is we're going to wait for the reversal bar on a small chart. The top of this bar is the beginning of the pullback. The tail of this bar is your perfect entry. And then all of that momentum pushes you right to your target. So to find what we call the window of opportunity, the point where the market is most likely to bounce, we're going to do a couple things. The first thing we're going to do is patiently wait for a reversal bar, guys. And I'm going to show you a lesson. There's a lot of people in the room, and I like this lesson a lot, that are taking trades where they're not waiting for the pullback, and they're just jumping into the market. And this is a momentum style trade and something that you're going to work your way into. But the second price gets to the other side of these small triggers, this reversal bar prints, it says, hey, we're losing a little momentum. The small crowd's beginning to fight. So at the time of the reversal bar, we're not jumping into the market. The reversal bar is not our entry. It's actually a showing that momentum is dying a little bit. We're going to first look for triggers, large and synthetic. They should be overlapping one on top of the other. And then once we've identified from the highest line of the triggers to the lowest line of the triggers, we know that our areas have to be inside. There has to be an area inside of favorable large triggers in order to take the trade. So I'm looking for fibs, I'm looking for mid bands, and I'm looking for yellow one-to-ones, but I'm insisting that they are inside of those trigger lines. From the mid band to the yellow one-to-ones, this is the highest point of support to the lowest point of support. This blue box represents the point where the market is most likely to continue, where the market is most likely to bounce. This pullback is like chucking a tennis ball as hard as you can, and these areas inside of triggers give it something to bounce off of. And you don't know if it's going to bounce off the high one or the low one, but you know that this is where your success lies, guys. This is the entry that typically wins 70 to 80% of the time. This is your highest chance of success, the one that creates confidence, and you're just going to activate a limit order right at the top of that window of opportunity. And you're going to say to yourself, I sure hope the small crowd can push down, and if they hit my limit order, I'll be in a trade, and I'll be in a trade with momentum, a clear path, and having entered where the market is most likely to continue. And the same look is true going short, guys. You wait for the reversal bar, and the reversal bar says to you, man, the small crowd is fighting. I'm going to look for trigger lines. The red box represents the trigger lines. The blue box represents the areas inside of triggers. Notice that it's only one line. Just a mid-band, guys. You have pinpointed with such accuracy that you've refined it down to one line inside of favorable large triggers. Your limit order goes a tick or two below that line, and you hope for the best. You hope for the entry. You hope that they push. We are not trading tails, guys. Tails are how you're going to go back and study. Because if you scroll back on a large chart and you circle the tail with the rules met, you're going to be able to come to a small chart and see if that circle lined up at areas inside of favorable large triggers. This becomes your look, the highest probability trend trade look, guys. If you go back and study this look, you should be able to take a picture. News in 1 minute. Thanks, Iron Mike. Snap that picture, right? Strong trigger lines, no terminations, perfect entry. I'm not waiting for the tail, I'm waiting for the area inside of favorable large triggers. This becomes your best look. And if you go to the live market, let's go back to the large chart. And of course it was a holiday, but let's see what this did right here, guys. Does everybody see smalls outside of the large? Does everybody see that we didn't reach the area? And there's one of those little tails, and guys, this is a pretty small tail. I don't know if it would have gotten there. So all I have to do is scroll back, and let's see what that circle lined up with. Oh, just above support. Might not have made it. What about this circle? Not every penny is your penny. Not every move is your move. Not every trade is your trade. But you can start going back and circling these tails and asking yourself, were the rules met? And guys, this is kind of hard when it was a holiday weekend. Because holiday weekends tend to not give the best of the best. There's a pretty good example though. Right back to support right inside of favorable large triggers. This is one that you could go through and you could talk about. You could say, hey, there's momentum and we didn't reach the fib and there's strong triggers and there's one line inside of favorable large triggers and that's exactly where it bounced. And what's cool, guys, is that you can do this. Your charts, where's my S&P large chart? Your charts go back 10 days. 10 days worth of information. You can scroll back and you can say, I wonder what this tail looked like coming off of that termination condition. I wonder if that was an opportunity for an entry. Let me go to my smaller, faster chart and let's see. Is everybody with me? All we're doing is we're talking about how to study right now. We're talking about how you can go back 10 days, every market, and develop a little trust in the look. Develop some trust in momentum, right? Build a little faith in the idea that that separation tends to push the market. And the one thing that can kill that great momentum is reaching an area. And what you're doing is you're piecing together these looks that create a high probability trend trade. There's triggers. They cleared it, and it pulled right back to resistance inside of favorable large triggers. Cheeseburger was a dud. Bummer. It happens. And here's one of the cool things, guys, is all we've talked about so far are entries. The only thing that we've focused on is getting into the market. We haven't talked about management. We haven't talked about getting paid, right? Right now, the only goal for me regards to you brand new users is understanding how to find this entry. Because once you know where the market is most likely to continue, then you understand where the market shouldn't go. And your initial stop as a brand new user, the most pragmatic basic stop, is putting your stop where the market shouldn't go. 4 to 5 ticks above those trigger lines outside of your window of opportunity. So if you don't know where it's likely to continue, how are you going to know where it shouldn't go, right? So don't put the cart before the horse. And you can identify it, you can get it, you can protect yourself. And remember, this is a trade that typically wins 70 to 80% of the time. This is a trade that when you follow these rules, typically wins 70 to 80% of the time. The highest probability trade that we take, or that we teach. which means that 20 to 30% of the times you've got to mentally be ready to lose that trade. And you don't know which 2 to 3 every 10 it's going to be, which is why patterns are so important. The rules aren't a hope that the market does what you want it to do, and the rules aren't based off of what happens once or twice. The rules are based on, I can tell you, thousands of pictures, thousands of hours of study with Nexgen. We've been teaching people to trade the markets for almost 30 years now. And these patterns repeat themselves over and over and over. And this high probability trade, if you took 100 pictures, you're probably going to win 70 to 80 of them, but you're going to lose 20 to 30. You have to mentally be ready to know where that stop goes, to know when your edge is gone, to know when it's time to jump ship. And the cool thing is once you get a confirmation bar, that reversal bar in the direction of your trade, you can reduce your risk a couple ticks above it for a short, a couple ticks below it for a long. And it's not unusual to see you guys taking trades that even though the rules were met, they didn't work. But because of great management and stop placement, instead of giving away $200 to $300 hoping for a win, you take a little $30, $40 hickey and you just simply wait for the next best trade. And that's kind of the first step in management is having advantages. Having the advantage of momentum, having a clear path, understanding where the market is likely to continue. And all of this is managing your risk before you ever enter the trade. So we focus on entries for about 30 days, guys. And there's very few people that at the end of 30 days with some focused study that can't put these together. Chart Reading 101. This sheet right here is designed to help you take the individual pictures, the pieces of a trade, and to commit them to memory and then ultimately piece them together to enter the market. So to get to where you want to be, you've got to be able to recognize some of these patterns and look quickly. You've got to be able to recognize strong triggers, right? Because if that's your first rule, you have to know what it looks like. Same thing with weak triggers, because if you know when the advantage is present, it's going to pay dividends to understand when the advantage is not. So take 25 pictures each. I just dropped it into the room, Luke. So what I'll do is I take this and I drop it into the chat box. And there's two paths. You can click the download, it'll go to your downloads folder, or you can literally just click on it and drag it over to your desktop and you can drop it right in anywhere you want. But what this does is it has you taking pictures of the individual looks. And here's the cool thing, and once again in this classroom, guys, if you're taking pictures of strong triggers, if that's today's goal is to learn strong triggers, and you come in and let's say you take this picture right here, and you say, hey Mark, check it out. Here's my strong triggers. Which is okay, right? What we're going to do, and Luke, I'm just going to use you as an example, I hope you don't mind, is I'm going to say, Luke, all right, so notice the position of the trigger lines here. Notice that the smalls are still inside of the large. And when I go back and I look at that very simple rule on momentum, if I go back to the user guide and I click on the T3 trigger lines, it reminds me that in order to have strong triggers, there has to be a separation between the two. So I love that you did the work, and thank you for posting in the room, but let's go back and let's focus on this look here, that separation between the small and the large, creating that advantage of momentum. And what you've done is you've said, hey, I'm dying to learn this, and I took the picture, and it's okay that I made a mistake, and I'm going to say, Luke, I want you to take this picture, and I want you to drop this one into your weak triggers section. And I want you to say, all right, this is where I don't have the best advantage, but look at that. Weak triggers turned into strong triggers. That was actually a pretty good trade right there. And you're building this repertoire, if you will, of understanding the looks individually. But don't just take pictures and drop them in. Talk about the whys. Talk about the look. Why is it strong triggers? What does it mean to me? What's the advantage? Why is it a termination condition? What advantage does that take away from me? And then you're going to piece these looks together, guys. And it's only 245 pictures. And 245 pictures seems like an insurmountable task to most people as they come into this room. That's going to take me forever. Guys, the only way to eat an elephant is one bite at a time. right? Has anyone ever heard that? Otherwise, it becomes overwhelming. Back in the days when I was a personal trainer, everybody wanted to lose 50 pounds, but I refused to let them. We focused on losing 2 pounds a week, and it never seemed overwhelming. And guys, learning to trade the software is the same way. Make sure that you understand strong triggers so that you can couple it with a clear path. And then once you have those two, man, you can minimize your large chart and do nothing but go through that little sequence of finding your entries. And that's how you enter the market. That's your trade. So the more pictures you take, and I do have some people in this room that have gone through and done this exercise or most of this exercise, and every one of them has told me that it pays dividends. So start taking those pictures, but just do 5 a day, right? Do 5 strong triggers, 5 weak triggers, and hell, call it a day. And then come back tomorrow and start back up. So commit to being just a little bit better every day. And that's what this 101 does for you. I'm also going to give you the high probability trend trade checklist, guys. What's it going to take to get you into the trade? Here's a printable version. This is the one that we didn't really talk about. Is the market coming from a good top or bottom, guys? When a termination condition reverses the market, that creates strength. When decisions were made at a key area on the large chart that push the market the other direction, that give you your rules met, that is the highest probability trade that you can ever take. You can still take this trade without a good top or bottom, but manage it tightly. If those divergences start printing, you're keeping eyes on it. And this reminds you that you need strong triggers, that you need no terminations. And guys, look at the language. I want you writing this on your charts. You need an area inside a favorable large triggers on a smaller, faster chart. That's your best entry. I'm going to give you this one in the room in the same checklist. So if you're taking those pictures, Luke, and you're like, oh, I'm going to go take 10 pictures of strong triggers, here's your cheat sheet. This is exactly what it looks like. So both of these are coming in the room right now as well, guys. And this one has strong triggers, and then the opposite, weak. It has termination conditions, clear path, potential, and it also has what's my order of operations to get into that, right? Reversal bar starts the pullback. Window of opportunity is inside of favorable large triggers. This is where my limit order goes, and these are outside of the window. They're not a part of my entry. And guys, I promise you, if you keep it simple, sounds good, Jonathan. If you keep it simple in the beginning, if you let it be easy, my small triggers are up, but my large triggers are down. I don't have momentum. Price reached all these areas, the triggers are beneath. I don't have a clear path. Guys, that tells me that I got absolutely nothing to do right now. My rules aren't met. And I know that because I can't mark yes on my checklist. So I'm going to give you one more thing here, guys. And I broke these down into individuals. This is the KISS plan for the high probability trend trade. This is the Keep It Simple Sunshine plan for the high probability trend trade. And guys, this plan is a stepping stone in your learning journey. This is a stepping stone. This isn't the end of the road for you. This is the beginning. This is you building a foundation. You are going to build the most glorious skyscraper that anyone has ever seen, but you've got to lay 80 pounds of, or 80 feet of asphalt first to make sure that it doesn't sink into the swamp. So this is your stepping stone. It's designed to optimize your chances of success with the high probability trend trade. It's designed to keep you focused on the best of the best. And then through simulation, study, class feedback, and continuous practice, you'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. That is my brother having fun with AI about 6 months ago. Guys, that's a clever way of saying once you can read your charts, you're going to see things. You're going to find other advantages. You're going to recognize when it's okay to bend your rules or create a plan with different rules. But in the very beginning, guys, keeping it focused, keeping it on the absolute best, is going to give you a plan that's going to give you the opportunity to feel the success of winning while you learn to read your indicators. And the simple plan for consistency, don't fight your large chart. It seems silly, right? Well, of course not. Large chart leads the way. Guys, this is the most broken rules ever. And how to commit financial suicide. This is tongue-in-cheek from my brother. He wrote this years ago. Warning signs, your friends are in trouble, guys. They're trading against strong triggers. They're making the decision to fight the momentum on the large chart. They rarely win. You will get to a point, perhaps, where you find that it's okay to do that because of patterns that you've recognized. And Ron calls it the indigestion trade on me now. And he's found that instance, but he's done it. He did it through 6 months worth of study, guys. The other one is trading into termination conditions. These are the two most common mistakes that new users make. And simply avoiding those two mistakes is gonna take like, I don't know, 50-60% of the problems out of it for you. And remember that patterns are based, or rules are based on not the one time that support breaks, but rather rules are based on termination, didn't break, termination, 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 termination. Oh my gosh, there's so many of them. And there's instances where there's overrun, and there's instances where they break, and those might be an opportunity to capitalize. But it's the old, 60% of the time, it works every time. So we're trading a statistical advantage. We're trading the idea that I don't have to be the last guy in short, right? And I actually don't have to be the first guy long to find success with this software. If I'm patient, if I wait, if I follow this very simple plan laid before me, it'll optimize my chances of success. So you're defining your entry. Take 20 trading days to define your entry, guys. If this is the only thing that you focus on for 20 days, if you scroll back and circle tails, if you participate in class, if you fill up that spreadsheet, by the end of 20 days, you are going to be so bored with the high probability trend trade that you are excited to go find other opportunities. If you skip this, you're going to be wondering why the hell you can't seem to find a trade. Trust me, I've seen it for 3 years straight. But then you have to manage. Once you get good at entries, guys, you got to do something with that great entry. And great entries create manageable trades. Great entries reduce risk. Great entries create more profits. Great entries keep you from trading into areas that may stop the market or keep you trading without the advantage of momentum. But you've got to do something with that great entry. And then once again, that magical phrase, right? You're going to create a plan tailored to your personal goals based on your ability to read the indicators. Your management plan will grow as you grow, and it will be easier, and you'll hold for longer moves, and you may be a little more loose with your stops. But until you're a chart reader, keeping it very mechanical, the same way you're keeping your entries mechanical, produces huge dividends, because what you're doing right now is you're developing trust in the software, trust in the methodology, trust in the idea that when you focus on this high probability trend trade, you're taking a trade that typically wins 70 to 80% of the time, and you're proving it to yourself right now. And I want you guys, new users, always get a kick when I say this. I want you to go at this full of spite. I want you to look at this plan, and I want you to say, you know what? To hell with you, Mark Novak, snake oil salesman. I'm going to go back and I'm going to simulate, and I'm going to study, and I'm going to get feedback, and I'm going to practice, and I'm going to prove you wrong. Do that. And if you do that, guys, you're with me forever. I'll be on your Christmas card list. That's just how it works out. So your management plan, just like your entry plan, is very mechanical. And it stems from your ability to get in where the market is most likely to continue. And if you can't get in where the market is most likely to continue, it's going to become difficult to manage. And there's two options, right? You get in, and the market's either going to go up and hit your stop, and that's okay. Sometimes the market is wrong. But the key is make sure that you gave yourself every chance of success, right? And if it goes up and hit that stop, you will literally get to a point in your life, you're like, whatever, I'll just wait for the next one. I'm playing the odds. But with all those advantages, you're more likely to get a reversal bar in the direction of the trend, guys. And once you get that reversal bar, you're going to reduce your risk 2 ticks above that reversal bar. Or in a long trade, 2 ticks below. And you're going to say to yourself, there's nothing else for me to do. I'm not in control of anything beyond my rules being met. And my rules say if I get a reversal bar, then I must put my stop 2 ticks above it. And guys, they can still come up and get you, but you're forcing them to come get you. You're not throwing your stop right inside of a window of opportunity and saying, man, I sure hope, right? And then with all that momentum and that clear path and that perfect entry and that reduced risk, more often than not, that market's going to hit your first target. And for you new users, and this is a little frustrating for some of you guys that believe everything needs to be a home run, it's only $100. And I want you to think of it this way. If you're walking down the street and you see a $100 bill, you don't hesitate to pick it up because $100 it doesn't suck, guys. And once you hit this $100 with momentum, once you hit this $100 with that clear path, you're paid. It's in your account. Your butterflies from your stomach go away and your palms dry up, and you just feel awesome about the world. And you're like, oh my gosh, I just got paid, and you're going to go to break even. And you'll abandon this break even stop with a little bit of experience, but in the beginning, what it does is it says, hey, Morgan, you just got paid. You have no risk. Dude, sit on your hands. Let's see if it pushes to that next target. Sometimes it will, sometimes it won't. But if it does, if all of those advantages get you to the second target, guys, what you did is you just took a $300 trade. Your second target's only $200 off in the distance, which means 2 contracts, 1 trade, every advantage $300. But Mark, how am I going to get rich on $300? Well, $300 doesn't sound like a lot to a lot of us, right? Do that once a day, it's a $1,500 week. That fattens my wallet up a little bit. That $1,500 week is a $6,000 month, and that translates to a $72,000 year, roughly. And imagine when you're so comfortable with this look, that you're so comfortable with this entry, that you're so comfortable with this management, you let your profits turn your 2 lot into a 4 lot, right? And now suddenly on the same trade with the same management, the same conservative approach, you're up into the 6 figures. And then maybe you use one of those trade copiers, like, what is it, Replicanto or something, and you can take that same $300, but it'll multiply it across 20 accounts. So from one trade, suddenly it's a $6,000 day, guys, and it's not uncommon to see Nexgen users with $30,000 weeks and $120,000 months, not from trading multiple contracts or all the trades, but rather from taking the absolute best trade and just using a trade copier across multiple accounts. I see it all the time, and it's pretty cool to see because there's so much opportunity. You don't have to be in every move in order to get paid. You don't have to be the first one in. You don't have to be the last one out, guys. I like to think of it this way. The people that move the market are sharks. They have the money to create trends, momentum, they react to areas. And if I just cruise with this guy, right? This guy's like, hey, let's go up fast. There's nothing in my way. I'm like, all right, saw that tuna in half. I'm going to eat a fin, right? I'm going to take my little bit, but I'm going to take that little bit 3 or 4 times a day. And it's going to add up, and it's going to pay dividends, guys. And I don't have to be the first guy. I don't have to swim in front of this guy. I don't have to get to the tuna before him, because really the tuna's going to kick my ass, right? Go with the flow. Trading is a lazy river. And the more advantages you give yourself, the more laid back, the better the pina colada tastes. So is everybody cool? High probability trend trade. Look at that. Termination never broke, and down it goes. Guys, I want you bored for your first week, because that boredom, that focus on simple rules and execution, what it's going to do for you is it's going to pay huge dividends. It's going to pay huge dividends in the long run. And let's see. Let's go back to crude. Price comes and reaches the mid-band. Jonathan, I don't know if you're back yet. Does everybody see how there was room for a full bar to get back to those large triggers? Ladies and gentlemen, this is what we call the gap theory. And let's take a picture of it, because this is a termination condition. This is when the mid-band behaves as a termination condition. So I want you guys to recognize this. And I'm gonna give the full gauntlet here. If price accelerates away from the large triggers and hits an area, in this case it hits support and a mid-band, it means, like a slingshot, price is likely, not guaranteed, it's not written in stone, guys, but it is likely to close the gap. What does that mean? It means no shorts, right? But Mark, I have odds favorable momentum, no shorts. It's like a vacuum. It doesn't mean go long. It simply means this is a termination condition. And going short into it takes away my advantage. The trigger line location gives me one more level of confidence to not feel left out and take a short, guys. And this is your gap theory. I'll drop this picture in the room, but I would take that picture and I would go to patterns that repeat themselves and drop it in there. And guys, if this is something that you want to study or something that you're working on, my spreadsheet, the one that I put in the room for you, probably has 10 to 15 pictures of the gap theory. And it's just when you shouldn't be trading into a mid-band. And let me show you something about patterns. Let's see. Mid-band, full bar away. No short trades into this area. Let's see if it happens again. Hit support. You think it's going to break, but the large triggers are a full bar away and it closes the gap. Not as many as usual. Look, there it is. Back to the gap. So this is a pattern that repeats itself, guys. There it is again. Mid-band, floating in the middle of nowhere. Large triggers didn't follow. Sure enough, it closed the gap. So patterns repeat themselves every day. Nexgen has done tireless work to get you to the point to where you can recognize a few basic patterns to give you the highest chance of success so that you can grow a trading plan that makes sense in your world. And I'm going to share this real quick, and then we're going to take a break because I firmly believe in breaks, ladies and gentlemen. The key to everything that we do, I mean everything that I teach in this classroom, is that foundation. Understanding three very basic concepts. Understanding momentum, understanding a clear path, and then finding your entry based on those two advantages. So for you new users, guys, I blanket you with very conservative rules. We're 100% focused on speaking to ourselves in terms of advantages, and I give you that solid KISS plan. Did I drop that in the room? I may not have. I give you that KISS plan for taking the high probability trend trade. And it optimizes your chances of success while you learn to read the indicators, because I want you to be a chart reader. And if you commit to being a chart reader, you're going to become a trader. So for you new users, all termination conditions are bad, right? For you new users, trading into a termination condition is horrible. Financial suicide. For you new users, areas that aren't inside of favorable large triggers, oh my gosh, just shoot yourself in the foot, right? And it's not true. It's not true that these things are always horrible. But until you have the reps to understand, right? Until you learn your rules like like a scholar so you can break them like an artist, this is your highest chance of success. This turns you into a chart reader, and this brings you the confidence to keep you moving forward. And then the more time you spend with it, the more you'll see. So, and I like to do this as we come into the second hour, guys, because as we come into the second hour, you're going to see trades that are not high probability trend trades. You're going to see people that have traded into areas, that traded without momentum, that didn't trade from areas inside of favorable large triggers. Don't play trade police, guys. If you're a high probability trend trader, these don't fit your rules, but they may fit their rules. They may have studied, they may have participated, they may have filled a spreadsheet, asked for coaching, and they created a plan that works for them. So don't get caught up in what you see. I'm going to take every trade that's posted in this room and I'm going to go back to the three advantages. And then 30 days in, you're going to start to see things that you never saw. And 60 days in, you're going to find more trades. And 90 days in, you're going to be managing so much more aggressively. It's going to allow you to take more chances, if you will. But you have to first learn the process that yields results, guys. The whole goal of being a day trader is making money. The whole goal of being a day trader is getting paid and filling an account. And having a statistical advantage is the easiest path of least resistance to do that in the beginning. And then you will, if you're okay not trying to trade like the people around you, but rather focus on your own success, you will find an extraordinary level of success following that KISS plan. I've been watching it for years. So the key is to question everything, guys. If you're not sure, ask a question. If you don't understand a concept, ask a question. If something I say seems to contradict what you believe to be true, tell me. Because sometimes you're going to teach me how to teach this class better, and sometimes I'm going to be able to clear up a misconception. And question everything, guys. I do encourage it. I will never shoot you down for asking questions, but you have to tell me why. If you post in the room and you say, hey Mark, look at this, man, I'm such a badass. I went long right here, and I took an exit right here. You better be ready to defend that in class. You better be ready to tell me why you went long against strong triggers, why you went long when this area had the potential to break, why you didn't trade from areas inside of favorable large triggers. And guys, I'm not opposed to telling you that you got lucky. I'm not opposed to telling you that you took a trade that's going to whip your ass 90 ways to Sunday more often than it doesn't. I don't mind doing that because I want you guys erring on the side of success, having advantages. And then when you do take this long trade, and you guys know who I'm talking to, you better tell me why, like it's a court of law, or all I'm going to do is talk about everything that you're fighting. And I'll have absolutely no idea what you did, and I'll do my best to not confuse new users. So that's what the second hour is we're going to go back and we're going to click on everything. But guys, I'm going to stand up and take a break. I'm going to go take a deep breath, maybe have a popsicle, who knows. I encourage you guys, do the same. Look at this. That termination reversed the market. I've got momentum, and oh my gosh, there's nothing in my way. I wonder if activating a limit order just above the highest point of support inside of those triggers is a good idea. Does everybody see what I just did and how quickly I did it? The path is up, right? The trend is up. The momentum is there. The path is clear. And those are the only areas inside of triggers where I anticipate a bounce. Take a picture. Annotate it. Guys, double check my math. See if my rules are right. Post it in the room if you've never posted in the room. And I'll be back in about 5 minutes. Breakfast-wise, should have a box of cereal for you. You're on your own. There's steak in there. I was about to say, there's steak in there. Yeah, eat some steak. Ribs, nice. You're awesome. Oh, there she goes. That's it. Sometimes she's like, oh, you're doing stuff? Here, let me mess with you. Hang on a little while. Glad you made it safe. All right, guys, and we're going to get back to work here. So, Morgan, when I get back, are the white dotted bands on the 8 range considered a term? No. Where do termination conditions happen, Morgan? Guys, I go Sunday school answers all day long. Large charts, right? It's just large charts. Large charts define the problem areas, guys. And it really is that simple, Morgan. And I know that it seems almost too easy. And I'll show you. Let me pull up a range chart. All these white dotted lines is it's a channel. That's all it is. So if price stops right here at the channel, what did it look like on the large chart? Let me find the circle. Check it out. It kind of lines up with a termination condition. And Morgan, what you're doing right now, and I'm totally okay with it because I don't tell people how to trade, is 30 days in, you're giving yourself a lot to think about, right? Because now you're starting to wonder about these pink lines, and now you're starting to wonder about these green lines, and now you're starting to wonder about these white lines. And does this divergence here have anything to do with the divergence on the 5-1? And how come this divergence isn't on the 13-2? And man, I'm telling you, I love a range chart, and I use a range chart. But Morgan, I've been doing this for almost 4 years. Range chart, actually, gosh, it's more than 4 years now. Range charts make sense to me. I've done a lot of study. But if you don't understand the termination condition, well, the range chart's useless to you. And if you don't understand the rules for entry, the range chart is useless. It's too much thinking. And I see this happen a lot with newer users where they're like, well, I saw Mark with a range chart, let me add it. I saw Paul with a 21 chart, let me add it. And I'm going to encourage you guys, and I'm certainly not going to force you because that's not my business. Keep it simple in the beginning. Let it be 2 charts, let it be 3 rules. Get really good at these advantages. And I promise you, Morgan, what you'll do, and I'll show you exactly how this will work, is you'll start saying, man, I have momentum and a clear path, and I have momentum and a clear path, and I also have momentum. So what have I done? I've taken a 3rd chart and I've done nothing but confirm momentum. And that's what I tell people. If you are a brand new user, get rid of this, right? Get rid of market flow. Get rid of divergence potential. Get rid of the range bar. Get rid of the pro trader and leave nothing but triggers on there. And use this chart before you use it for anything else to confirm the momentum that's getting you into a trade. Does that make sense, Morgan? And what it does is it's taking a familiar concept and allowing you to add another layer of advantage without getting all caught up in the idea that you have to figure out what all those different pieces mean. So simplicity. I haven't done this in a while. Have you guys ever seen The Last Samurai? I go back to movies a lot. Too Many Mind. Do you guys remember that? Too Many Mind. Mind the sword. Mind the people watch. Mind the enemy. Too Many Mind. Guys, trading is a lot like that for new users. If you try to focus on too much instead of what's important, you're going to find everything that you're not looking for. It happens. So great question, Morgan. Sorry that probably wasn't more helpful. Maybe more of a cautionary tale, right? All right, guys, we're going to get going. And I'm going to ask you guys, a lot of you posted a lot of stuff over the weekend. Do you need feedback or are you holding yourself accountable? Awesome. It's just easier if you get the basics in. Guys, there's a lot of you that took a lot of trades without much annotation and post them in the room. And I'm always willing to go back and look at those trades and make sure that you're getting the answers that you need. So let me know if you needed me to go back and look at something. And I'm more than happy to. And there were some pictures in there that were like 7 pictures of one trade holding it. And that's awesome. But that's a lot of information that. So I'm always willing to, or repost it when class is going. And I think that's easier because a lot of times we hold ourselves accountable. And Jonathan, did you post over the weekend? The cool thing, Daryl, is that the older lessons are tomorrow's lessons too. It's the same thing every day. That's what really creates the simplicity. Oh, then we're good. Jonathan, you're actually where we're getting started here. So let's do this. Smalls were still red at the line. Oh, at the time. Okay. So you had odds favorable momentum, right? That's what that means, is that you still had odds favorable momentum. You say some practice this morning using limit orders. Why not no stop and target showing up? Also, the close button would not work. You had to buy the market to get out. When you tried to move the stop up on the second trade, it would not move. It would not have X. Redo your question. How do I have automatic stops and targets on limit orders? And can we discuss the buy limit trade at 53.2775? This is perfect. Hey, Luke, I see you. So you are already in and out of the market here. I'm trying to get the workings down. Okay, so this is just kind of stops and targets, right? So let's do this real quick. Jonathan, let's turn. This is for everybody. Stops and targets. If I want to buy a pullback at an area inside of favorable large triggers, I have to right click and I can click that buy limit. And we've already missed our trade here. But what you have to make sure of, Jonathan, is that over here on ATM strategy, that you have some sort of strategy in there, whether it is a 4 lot, a 2 lot, a 1 lot. Nexgen gives you about 25 strategies here. This is crude oil. So on crude oil, I'm looking at a 12 tick stop typically. And that gives me reaction time to put it where the market shouldn't go. So you have to make sure that you have stops and targets in there. If you don't have an ATM strategy and you enter the market, you're not going to have stops or targets in place. If you are not in the market yet, if all you have is a limit order, the close button isn't going to work. Well, maybe it will. Cool. But you're not going to see your stops and targets yet. The only way you're going to see stops and targets is if you're in that trade and you have an ATM strategy. So, for example, if I put this ATM strategy in place and I enter the market, it's going to have targets up here, right? And if I click that green line, I can move it up, down, anywhere I need it to. And that's going to help me do that. My stop's in place. I can put it where the market shouldn't go. And as long as I'm in this trade, I can move these stops and targets. So maybe I'm looking for $100, right? And I put it at 51. Or maybe I'm looking for $200 and I put it up, you know, at 61. I got my reversal bar. I can move my stop just below it. So if you need a limit order
filled
on your small chart, if I right click above the most current price, Jonathan, sell limit 2 is my option, which means that if price comes up and hits this, I'm in a short position. I want the market to go down. Of course, I'm not doing that with momentum up. The flip side is if I want to enter at this mid band, I can right click below the most current price and hit buy limit. And this is kind of the methodology, right? We're buying that pullback to the area inside of favorable large triggers. So now I have my limit order. Does that make sense? So I'm waiting for the pullback to the area inside of favorable large triggers. So we're not using buy market or sell market. We're actually right clicking and we're activating limit orders below price if we want to go long. And we're activating limit orders above price if we want to go short, because we're going to buy or sell that pullback. Are you with me so far?
Order canceled.
ATM strategy right here on the side. So you have to activate an ATM strategy, and these are all of your options. So you have to have one of these in play. If you don't have it in play and you enter the market, so if this is, if this says none and I go long, I don't have any stops or targets anywhere. But if I have one of these and I go long, now I have stops and targets. Absolutely, they will work with a limit. They just have to be activated over to the side. And then if you want this to be closer, click on the green and drag it down. And then what happens is the original target is in place until you click a second time. And guys, this would be one of those good pictures. Check this out. This bar hasn't even finished printing yet. There's the tail. And the tail lined up with support inside of favorable large triggers. Does everybody see that? Of course, we're in it super late. But does everybody see how it pulled right back to a mid-band right inside of triggers? And if you were in at 33 or 32 instead of 42, you already made your $100, guys. That's the high probability trend trade. Take this picture, annotate why this was a trade. This will help you. Small's above the large. They're wide, they're green, they're angled in the direction of the trend. Price didn't reach an area. Pull back to support inside of favorable large triggers. Guys, I can't make this up. This is the pattern. New users, this is what you're looking for. This bar's not even done printing. If it goes up, this will be your tail. Which is why we don't trade tails, because the bar's still working, but it's already bounced off of support inside of favorable large triggers. Pretty cool, right? Same thing every day, guys. Once you learn this pattern, everything gets easier, because you'll begin to recognize how to take advantages outside of just the high probability trend trade. You'll begin to understand when momentum is such a key factor in the move that you can capitalize other ways. And that's when it gets fun. So Jonathan, we have another one for you. And I want to go through this. And guys, I'm going to show you. And this is why I talk about annotation. All right, so I'm going to use all the language here. Small's below the large, both triggers red, space between. What is that, guys? That's strong triggers, right? Isn't it crazy, Paul? How did I know that's what was going to happen? I don't have a crystal ball, guys. I have been known to use a magic 8 ball every now and then, but it's just a pattern. That was my woo. And you guys know where the proper entry was, right? We're in 10 ticks late. I'm going to see if momentum for the win. So, guys, can we say that rule number 1 is met? Does everybody see it? And this is one of the things that I like to do with new users. Guys, I'm such a fan of annotating charts. And then smalls through, large or not. This has the potential to break, but isn't broken. So the area is not broken yet. This is 50-50. It's not a clear path. But with that reversal bar, I had no divergence, strong triggers, areas inside of favorable large triggers. Guys, that's a potential entry for a medium probability trade. It's a great read, Jonathan,
Target
but
filled.
this is a trade that you can take a shot at. But look at all the indecision, right? Right at those key areas. Have you guys ever wondered, are they really making decisions at key areas? Guys, look at the scramble on a small chart when the large chart always says down. Of course they're making decisions at these key areas. You can give yourself the best of the best. Jonathan, it's a great read. I think that you could have taken a short there. It would have fit the rules. It might have stopped you out anyway. Even more so, I think you could have had a short right here, which was even higher probability. Your first pullback was perfect, and then things changed and changed and changed after the first pullback that you had to manage out of. And guys, just for the record, even our crappy entry, we're in $100 late, and the market is still going up with the rules met. You guys see that? Does anybody want to get paid?
Target
There you go.
filled.
Does everybody see that? From 33, it made it up to 53. That was your $200, guys. That was your $300 trade. That was live. That wasn't handpicked. That wasn't historical. Guys, this is what we do every day. Once you understand these patterns, you can capitalize on this look. And then once you've had the software for a while, guys, you start saying with all this momentum, I'm going to hold to the next fib. There's no reason to get out. Everything just keeps getting better and better. But you've got to be able to pinpoint this look. This is the picture, guys. You have to take it. And you have to say clever things. Like odds favorable momentum. Clear path, right? And you draw. There's my odds favorable. Smalls above the large. There's my clear path. And this, I think, is the most important thing for you guys. Areas inside of triggers. That's where it's likely to bounce, because if you put your order at these 1-to-1s, you never got into the market. There was one line inside of triggers, guys, and that's exactly where it went. I love this stuff. If you don't get giddy about this within the first week, I don't think you really want to be a trader. So let's go to the next pictures, guys. Let's see what other lessons we have here. But this is why we annotate charts. Talk about advantages every time. Talk about advantages. And Iron Mike says, he did a lot of study over the holiday weekend. You advise to put your limit entry inside of the large triggers on the 5-1 and wait for the pullback. Watching gold this morning, gold took off, but the pullbacks went beyond the large triggers to the mid-band. Do you find the mid-band to be a better entry place when there's a quick movement of the underlying? I don't. I don't at all, Iron Mike. Malcolm, it's because people have been asking the same thing over and over and over and over and over and over. We'll still go over there. No worries, Daryl. Have a good one. I hope to see you every day for the rest of your life until you just don't need me anymore. Safe travels. Um, so Mike, Iron Mike, let's do this two ways, if you don't mind. Just using your picture. Yeah, Gary, I asked if you need, do you need feedback? Because it's the same picture 7 times. You followed it with a reversal bar. It was awesome. Great trade. Nice hold. Were you looking for feedback on it? Or you just need an attaboy? Because that was certainly attaboy worthy. Let me answer Mike's. I'll go back to yours. So Mike, when we look at the large chart, there's your first circle, right? Odds favorable. Let's talk rules. Mike, is it odds favorable or anything can happen on the triggers? And really on all three of those. And you're going to see how cool this kind of works out. Anything can happen, right? You did have a clear path. So you have rule 1, you don't have rule 2, and Mike, you also don't have rule 3, right? So let me show you something pretty cool. And this is kind of a pain in the ass when you watch the market go up. You don't have momentum. You don't have an entry. Is only having 33% of your advantages worth the risk? That's the first thing I want you asking yourself. If I don't have momentum and I don't have a clear path, am I willing to risk all my hard-earned money on 33% of my advantages? And it's okay if the answer is yes. But you have weak triggers here too, right? And I'm going to tell you right now that gold is NASDAQ's just bipolar stepsister. Happens all the time. But let's go to the other side of it, Mike, where you have odds favorable momentum, the best of the best. You do have a 50-50, and you get a pullback right at those triggers, right? Right at that correction point, almost in between it. Pretty effortless. That's the one. That's the easy look. These are the I hope the mid-band holds look. So if you get in at the mid-band, where's your stop go without a window of opportunity? How much are you willing to risk on that trade? With weak triggers, with no areas inside. Some people will say, I'll buy the mid-band and I will give it 10 ticks, right? I'll risk $100. Are you going to risk $100 3 times against 3 divergences with weak triggers on the wrong side of the large? Or are you just going to take this one, make $500, and say, I don't need these to be successful. I don't need these trades to be a rock star to hit my goals that don't fit the rules. And you may one day, Mike, say, I'll work that mid-band. I'll work it over. I'll make it mine. But in the beginning, we're forfeiting a lot. And I don't trust a squiggly green line in the middle of nowhere to stop a market. The fact that it did this time is outstanding, right? If I had 1-to-1s, a couple fibs, they lined up over here, maybe. But not so much that look. Does that help? I have to go back to rules. I have to go back to a statistical advantage every time I look at my charts. And for me, I really do. I talk in terms of advantages, and I'm very willing to not take a trade at this point in my life. And I don't have a problem waiting 2 or 3 hours for a trade if that's what it takes to get my rules met. 6, 7, 8. All right. Here we go. Got to start with the entry. Odds favorable, down. Potential to break. Everything says down. That's a momentum trade to the short side. Everything says down. And you get out of your short. I love it, Gary. And then you take a long when everything rolls. And you're using a trailing stop behind the reversal bar. Then how are you still in on that reversal bar? Should be behind that one at this point. And then that's the same picture. And that's the same picture. And your stop, you're tightening it up into trouble. And you're tightening it up into trouble. And you're out. And then you are weak triggers, termination conditions everywhere. Divergence takes you out because you love money. And then you re-enter instantly because it may hit the next fib. Into termination conditions, weak triggers, and why did you take this trade? You say the stop should have been below the HVA, but if this divergence right at fibs with weak triggers and all the problems is enough to get you out of a trade, and this, let's let this be the conversation, Gary. Why are you entering back into the market? And I think this is one of the challenges. If this is ugly enough to get me out of a trade, I don't really have a reason to re-enter. And it does go. But it's hard to gauge that, right? It's an interesting entry because you don't have momentum, you don't have momentum, you don't have a clear path, you don't have momentum. And these are those trades where it's easy to say it might go there, but your indicators don't say that it's going there. And guys, this is experience, and I'm certainly not knocking Gary. Gary has his reasons for doing what he does, but this for me is an exit, and this is an exit, right? And if I'm going to take a momentum style trade, hoping that this area breaks, then I've got to at least have momentum, and that's the challenge here, is you are void of momentum on all of your charts. Does that make sense, Gary? And this is just kind of a, this is, man, from your exit and your hold and everything is freaking rock star. And I think what happens is, and I'm guilty of this too, is that when everything changes to a point that I'm willing to take it out of, to take a trade off, do I really want to jump back in? And I know somebody else that does this, and we've had, and this is where we differ in opinion. If I have enough compelling reasons to say I'm going to take my money, then for me personally, I want to at least get to the other side of it. Let me blow this up a little bit, and let me know what you think. Because guys, I don't tell you how to trade. If this area is really going to break, I'm going to let it break, right? And then once it breaks, once I get all my triggers through it, then I'll hope for a pullback. But this is the one with all of the weakness. and it's this right here. I love this. That hold, Gary, was brilliant. Look at the momentum. And then you waited for a change on the smaller chart at trouble to get you out. But this is my brother's thing to me. And this works mostly because my brother, I hate it when he's right because he's my brother. But I want you to see this right here. What he used to do to me on a trade like this, and I would lose, is he would say, Mark, is this your best look for a long? Is weak triggers and not a clear path your best look for a long? And then he'd go, he'd turn it on me. He'd go, that's an exit condition, right? If you were long, you'd get the hell out and not risk that big pullback that may be imminent. because weak triggers at a fib are more likely to hold than break. And and I had to use that very basic concept to decide whether or not I was willing to take that next trade. And I firmly believe that the market lets you get away with one just enough to make you believe that it's a solid plan. Does that make sense, Gary? Man, I love to celebrate victories, guys. And Gary's at a point where I feel like he's at that point. Look at his exit. He gets out of the short move and goes, hey, look, it's changing. It's time for a long move. And your hold is freaking brilliant. Everything about it's just absolutely beautiful. Good stuff. And the cool thing is, and let me go one step further, guys, when you're in at 88 and you're out at 22, you can risk $100, right? You can risk $200 taking the lower probability shots because you did it right so often that every now and then you can let that bravado kind of show. So, Gary, that's exactly what you did. You had enough green on there and you had enough money in the bank. You're like, hell, let's see if it keeps going. The problem is when people make that their first trade and then it doesn't work out. I love it. I love everything about it. So, yeah, thank you for telling me to go back to that. I think you missed it when I was asking earlier. I was like, anybody that posted before class, if you need feedback, let me know. So thanks for getting me on that one. That long is just as pretty as it gets, though, and your hold was outstanding. I'm going to say sorry anyway, Rob. It's just me. I'm a touchy-feely kind of guy. I don't ever want to hurt anybody's feelings. I don't want to discount your trades, but I have to go both directions on it. Right on. I hope it's all good news, man. All right, Mr. Flowers, coming from a weak bottom, perfect. All the momentum in a pullback. Oh, Gary said sorry. Yeah, Gary, you don't ever have to say sorry. Dig it. Where's your small chart? And there's all that momentum again. Another pullback. Look for the entry on the small chart with the pullback. Look for the entry on the small chart. And then when you get those weak triggers, blah. Oh, that's your strong triggers look. I love it. So I know that annotation is a little slower for you. I see what you did here. I love this. No, I don't mean that bad, right? Don't worry about that. You can put that if you want. Don't worry about that. When you're really just focusing on strong triggers, do an arrow where they're both wide, do an arrow when they close, right? That's your range. And then if you want to annotate extras, go, this is the range where I'll buy a pullback on the small chart. Don't worry about throwing all those rules in there, right? Because all you're doing is you're studying strong triggers. You're saying, these are my strong triggers. Everything, this is why, and this is what I'll do with them. I love it. Great stuff, man. Good picture. Guys, I'm telling you, the more you do this, the easier strong triggers just, they pop out at you. You're like, oh my gosh, I can't not see strong triggers when it does this. Good stuff. All right, Paul, we got you again. Doing strong trigger look again. There's your range. And then the area doesn't break, and it gives you odds favorable the other direction, and then there's your weakening. Absolutely beautiful, Paul. So can I ask, and you know what I'm hoping the answer is, but don't lie to me. Did it help to come through? Do you feel like it takes some of the weight off the shoulders? Because you're like, now there's just no doubt in my mind. I know what it looks like to have that advantage, right? And there's one of your pullbacks, and there's your first shot. And then you get like this, man. So Iron Mike, this is not momentum, right? But this is strong trending. These are the times where I'll buy that mid band a little arbitrarily. This is when I've got 40 bars in the same direction without a reversal bar, when I've smashed through all my areas, Iron Mike, that was it Mike or Malcolm? Who was it that asked about the mid band? Sorry. Morgan, it was somebody. This look 30 bars in with a clear path, this is where I may go after that mid band that's not inside. Because the market has established that there's just nothing stopping it. It's bull in a china shop. I'll keep buying mid bands until it doesn't work. So there is a time where it's appropriate. But it's that 30 or 40 bars, strong trending, same direction, everything going, and it's do it till it doesn't work. Good stuff. Paul W. That is a pivot. No trade short or long. How come? Why? And guys, this is cool. Newer users help me with this one. Let's look at rule number 1. Do I have strong triggers? Can you guys give me a yes or a no in the room? Paul says yes. Morgan says yes. Jeffrey Dean, what do you think? Jen says yes. Hell yeah, Jeffrey Dean says yes. So rule number 1 is met, guys. And now we have to see where is price and where are my triggers. All the same colors, space between the two, both are wide. Guys, that's a sexy look for momentum. Ooh, Paul. And this is what I rely on. So price reach support. And this is, Paul Flowers, this is exactly what I rely on. These are your small triggers. It takes 2 lines to create the small triggers. There's the top line and the bottom line. So this is one of those things where we believe that we have a 50-50 look, that this has the potential to break, right? But the reality is that my small triggers didn't break. Paul the bot gave you an answer. So it's into a termination condition. Does that make sense, Mr. Flowers? Price reached the area. The small triggers never made it through. Perfect. So can we say that rule number 2 wasn't met? Whoops, wrong one. Which means that if I'm one of those rule followers, it means no trade. Rule 2 not met. And here's the cool thing is Paul W. said, done, no trade, right? Because he's at a point where he's taken 1,000 pictures and he's annotated them and he knows exactly what he's looking for. And it took him probably, Paul, what did it take you? Half a second to say no trade? I'll take the picture, but not the trade. And guys, you have to celebrate these victories when you do these kind of reads, but you have to take these pictures to remind yourself what it looks like when there's no trade. And Paul, that was perfect. But because it's a classroom, I wanted to go through the whys. I wanted to talk about why it was no trade, because some people are saying, well, man, that seems like it would be a great trade. So we go through and we talk about those advantages. And guys, this is not a trend trade. But trend trade must be second nature, and only when you see these weirdo trades. So guys, this is a great example. And when I said fighting momentum and direction is horrible for new users, I love it. That's perfect, Mr. Flowers. And guys, do that. Steal everything in here. Work smarter, not harder. So guys, a tick off of support and everything says down. This second divergence says, hey, it's probably going to push up, maybe to the trend trade, maybe a little higher. And Ron has created a plan that fights momentum. And Ron has created a plan that's aggressively going against the trend. But I can tell you that Ron spent about 3 months and hundreds of pictures to feel confident with this look. And guys, he loves it. He says he gives me indigestion. I agree. He gives me heartburn in the 10th degree. Um, this is aggressive if you don't understand some patterns beyond the high probability trend trade. But his execution is 100% consistent, and it's working. So good stuff. And Andy, I love that you're learning to fall in love with chart reading. It's pretty awesome, right? And I've been saying for 4 years, guys, that once you learn how to read your indicators, once you can do those very basic concepts, you'll be floored at how well you know um, where the market is likely to continue and find entries, and where the market is likely to go and take profits, and where the market is likely to stop and not take that next trade, and where the market is likely to stop, where the market is likely to go, right? And then where else? I guess you can go back and say where the market is likely to continue. Three very basic concepts that are going to get you guys paid long term if you can keep it simple, if you can focus on it. Good stuff. I don't know about you guys, I'm having fun. Great post. You newer folks, I want you to be okay with questioning some of the stuff that you see. I want you to be okay typing in the room. I want to hear from you guys. And then, Paul, no trade short or long within the trade plan, because now there's that gap theory, guys. Price reaches the mid band. Price reaches support. The large triggers are above the reversal bar marker. And it just says, don't do it, not yet. And I want you to see something. That was at 10 a.m. this morning. Paul said, this doesn't fit my plan. Paul didn't take a trade. Paul, did you take a trade here? Did anybody get in here? Large chart still says up. Large chart still says momentum. Large chart still has a clear path. There's two entries that kind of fit within the rules. Pretty cool, right? That's all we're doing. All we're doing is trading patterns. And once you learn the patterns, everything else falls into place. Trading doesn't have to be difficult. Trading should be consistent. Strong triggers, clear path, coming from a termination, right back to the area inside of favorable large triggers. Malcolm, are you in here? The only thing that I would have wanted to see, Malcolm, is an arrow right there at the top of that bar. And I want you to say price didn't reach the area. Let's go ahead and annotate with all three rules, right? There's rule number one, perfect. There's rule number two, perfect. And now it's not so much an entry point inside of favorable large triggers. And Malcolm, this is me being nitpicky, and I hope that you appreciate what I'm trying to do here. This was a pullback to support inside of triggers. And why do we do this? And Malcolm, you nailed it, right? Entry point inside of triggers. Is that the entry point right at the top of the triggers? Is this the entry point? Is it one of these that are still inside of the triggers up here? I know you put the circle. If you use the language, pull back to support inside of favorable large triggers, well then what you're doing is you're confirming and validating that this is your best of the best. And that language gets you always looking for that high probability. No problem. Jonathan, thanks for being here, man. I got to tell you, your charts are getting better and better and better. Your reads are getting better and better and better. I can't wait to see where we're at 30 days from now. You're doing awesome. Great lessons in there. Go practice stops and targets if you get time this afternoon. So Malcolm, 100% perfect read. But for the sake of being able to do the same thing every time and always talking about advantages, don't be afraid to write all of the rules on there. And then tell me something here. Strong triggers, potential to break, Pull back to support right inside of the triggers, right? Top of the window gets you into a long trade. Stop had to go down here until you got the reversal bar. And if you were in at 53.4, there was your $100 right there. You're already break even. Go de-holiday the front yard. Have fun. Have a great day, Ron. Great read, Malcolm. Great charts. And guys, when I talk about getting all the advantages on there, I'm not trying to produce work for you. What I'm trying to do is get you guys to the point to where you're always thinking about three simple things, right? You're always thinking about three simple things. You're always in this mode of, I'm going to police myself into taking trades that have a statistical advantage. And once I can do this, I can find more options, guys. I can find more ways to get into the market. Once I understand the high probability trend trade, well, then I might go to that HVA trade. I may go to that momentum trade. And I'm going to work with you on it. Same thing in class, same way we're doing it. So that's kind of where we're at. And guys, it's still going up. Large chart still leads the way. I think Gary said that this morning. One of the best lessons you can teach yourself in the beginning is that the large chart leads the way. Oh, or it just disappears because I draw on it too much. This is one of the reasons that we use the capture software, guys, is because the more you draw on a chart, the more likely it is to crash on you right now. And that's why we use these capture softwares, to make sure that we're not creating layer after layer after layer after layer on top of those large charts. Large chart leads the way. It's a weird lesson, but it's such a good one. And you know, Paul, it's funny because I say it every day. Small chart will talk you into some stuff, won't it? And then on that same token, Morgan, that range chart is the prettiest girl you ever met trying to talk you into doing something stupid. It's once the large chart leads the way, things tend to work out. You can't talk to women. Beautiful, Paul. That was pretty easy, wasn't it? And the large chart is keeping you in crude, right? Well, it never changed. One divergence doesn't scare me, right? Paul says, I'm just going to go ahead and make $300 and call it a day. Jen says, large chart says, we're probably going to hit a fib. Did it hit the fib? I don't know where your fibs are. I haven't found a reason to exit yet. If anything, I've only found a reason to add to my position. But guys, that's that next level, right? This is the next level. But Morgan, how many? Oh, I love that you put that. So we're going to do two things, Morgan. Divergence happened inside of large triggers. All right. Okay. Guys, I get excited because this is how you get better at stuff. Watch this. Things that are going to happen on your small chart, Morgan. And let's go with this real quick. Which chart leads the way? Large chart, right? So if I'm letting the large chart define direction, hold on, let's see if I can make this happen real quick. If the large chart defines direction, can we agree that it's set up? If the large chart defines momentum, can we agree that the momentum is outstanding? This is how you learn to not fear the small chart. And if the large chart defines areas, can we agree that it didn't reach an area? Well, it did now. So the large chart says up, it says strong, and it says clear path. So Morgan, there is one reason on the small chart to keep me out of a trade. There's one reason and one reason only on a small chart that I'll choose not to take that trade, and it is the only termination condition on a small chart, and that's 3 divergences in the same price range. Does that make sense? When the large chart says termination, creates a reversal, gives me odds favorable, everything says go, the only thing on God's green earth that's going to keep me out of that trade is 3 divergences on a small chart. Does that make sense? It's my only small chart termination condition, guys. So what happens with new users is they go, oh, but I have a fib. Well, areas are defined on the large chart. And guys, the large chart is a different kind of chart, right? It's a 13.2. It's not a 5.1. I want to show you guys something pretty cool. And you may have, and that's going to happen in the beginning, Morgan, which is another reason why keeping it super simple creates advantages. Let me find this picture that I have real quick. Hold on. And I want you to see this picture, guys. This is pretty cool. So the large chart here says odds favorable momentum, and the large chart here, oh, Gary, I hope it all works out. One of the heart surgeons my wife worked with used to do volunteer work at the VA to get you guys in quicker. Maybe there's someone in your area that does that too. So look at this. Does everybody see how on the large chart it's a 50-50, right? The small triggers have smashed through tons of momentum. But if I look at the small chart, it pretty much looks like a termination condition. This is why we let the large chart lead the way. Because if you let this fib scare you out, you don't take this trade. You don't take that momentum down to the next key area. So we really focus on this one, guys, and it never changed. One divergence doesn't scare us. Small triggers turning against you, ladies and gentlemen, on the small chart. Let's do it again. Let me pull up the entry picture. This is, I think, one of the best lessons, guys. And I'm going to tell you right now, I was notorious. Let me show you all the things that made me pucker on a small chart. Large chart was perfect, the same way crude was. I would get a divergence right here, and I would say no trade because there's a loss of momentum. And my brother would say, but Mark, momentum is defined on the large chart. And then maybe I'd have yellow 1-to-1s here, right? And it was like bink, 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 and it bounced off of 1-to-1s. And I would say, oh, that's a termination condition. And my brother would say, but Mark, aren't termination conditions a large chart thing? And I was like, oh, yeah, you're right. And then maybe the small triggers turn against me. And I was like, oh, no, I'm losing momentum. And I had to be reminded, guys, I'm telling you like 100 times. Momentum happens on the large chart. And you will, Morgan, and everybody else in this room, is you will look for reasons to not take a trade because you don't want to give money back. But if you let the large chart give you this best look, you're really, notice that it never made it below the large triggers. It never made it past that correction point. And you've got to go back and you've got to study this look so you don't let these little things scare you out of it. Does that make sense? So the only thing that's going to keep me out of this look, Morgan, is 3 divergences. Anything less than 3 divergences can kiss my ass. I'm in this trade. But I've also got 100 pictures of it. And then Jen says we reached a termination. Tell me something. And guys, I'm just curious. Tell me something. If you exited at 79.73 right there, is there anyone that wouldn't be feeling like an absolute badass? You knew exactly where the market was likely to go. You knew exactly where the market was likely to continue. And now, because all the triggers are below, you have the potential. You can say to yourself, well, this might stop it. It may create a push down. This might be the end of the up move. I just don't know. And if it breaks, we'll look for more trades. But it's okay. It's okay. Nope, Mike, perfect. 3 of them, right? 1 of them. So what is a divergence? A divergence is a loss of momentum, right? What do you suppose we need to get us back to our perfect entry? There's got to be some loss of momentum. There's got to be some push down to get us to our entry. That divergence probably helped us. Helped us get down to that mid-band. It was just what we needed to capitalize, to use that small crowd. Pretty awesome. And then, Rob, you'll talk yourself into trades too. So here's your life cycle, Rob. First, I'll just use this. First, you'll blow every rule and take everything you see. And you know what? This is perfect if you're posting in the room and getting feedback, because we'll work together and we'll weed it out. Then you'll talk yourself into breaking your rules. Sorry about this spelling, because I want to be active. And that's perfect if you're posting in the room, because then we can talk about it. And then you'll be like, man, I keep doing all this stuff. So you'll talk yourself out of trades thinking you are being safe. When the reality is you're just missing the best of the best. And if you throw it in the room and tell me why, that's perfect, because we'll work together to fix it. So guys, this is normal for everybody. This is everybody that I've ever met in the market. First, you take everything and you screw rules up and you blame the market for your losses, and you never post it in the room, and we never get to talk about whether or not there were terminations or a loss of momentum or anything like that, because you're an egomaniac the same way I was. And there's no doubt in your mind that you're 100% truthful and right on everything that you're doing. And the market sucks, and the software sucks, and I hate Nexgen, and I hate Mark, and crude oil can just kiss my ass because I'm perfect and the trades didn't work. And then you post it in the room and you find out that you just butchered everything. And you're like, oh, all right, so I need to work on it, right? And you start to understand your rules, and you're like, wait a minute. He said 90% of my day would be sitting on my hands, but that's some crap. I can't make money doing nothing. So let me start talking myself into trading into termination conditions. Let me take those areas outside of favorable large triggers, and then you start losing, and you don't want to post it in the room because, you know, once again, the market sucks, and Mark sucks, and Nexgen is horrible, and I can't believe it. And then you're like, you know what, let me just post this one. And you realize that you're breaking rules. You're like, oh, son of a gun. So then you overthink everything, and you miss every trade, and you're like, there are no trades, and I hate Mark, and I hate Nexgen, and this is such crap. And I can't believe that anybody would ever buy this. And if you never post it in the room, then you're convincing yourself that that's exactly what's going on. But if you post it in the room, good morning, Miss Debbie. You guys safe from all the storms? What you realize is that suddenly there's a really easy way to do it. And you don't have to overthink it. And you don't have to have extra charts. And you don't have to have all these conditions. All you have to do is follow the plan. And guys, that's hard in the beginning because you're brand new. Give yourself some grace. And that's it. Drop the F-ups in the room, because that's how we all learn. And guys, this is such a normal part. And if you think you're the only person doing it, we're good. Yeah, we're good where we are. It got really crazy here for a little bit. You know, my wife works up in Denton, Debbie, and she has a couple people that lost houses, and there's trees all over the parking lot in the hospital, but nobody hurt, so that's all that's important. It's crazy. That was a good storm. So, guys, embrace the idea that it's okay to make mistakes, but post them in the room. And I'm talking to you guys that aren't posting right now, that are trying to become day traders without feedback. It's hard, guys. And you guys that think that you understand everything, but there may be a little problem with it. Post in the room. Let's talk about it. And I promise you, we're going to get right where you want to be. And the great thing is that Morgan had the courage to say, but there was a divergence. And that just opened the door for an outstanding lesson. And guys, this classroom isn't good because I know my stuff. I've known my stuff for a while. This classroom's pretty amazing because you guys drop these pictures in here, because you guys ask these questions that no one else is asking, and everything gets better. All right, Gary, let's see. Why did you enter? Why? Why did you enter against triggers down? And why don't you have a large chart? Why do you only have a 21 chart with smalls below the large, below the synthetics? Why did you hold? Why did you enter down here against that momentum? Do you see how this is a pretty tough chart, right? If the large chart leads the way and you don't show the large chart, how can I give feedback? But you entered all the way up here. Why? And Gary, let me tell you that I think this is a good looking trade. Because you had support, because you had the reversal, because you have momentum, because you took a snapback, because you waited for everything to roll. It's a beautiful trade. But the one thing that everybody in this room is focusing on right now, Gary, is why the hell would Gary get in when this says down? And why would Gary get in when these triggers are below? And why would Gary? So, Gary, you had a freaking rad chart read. Share it. Say, this is what I did, guys. This is why I did it. This is why I fought this. And if you showed that large chart, ladies and gentlemen, the thing that you don't see is that he had a termination condition, and he didn't just jump in. He let his small chart tell him that that low was likely to hold, and he waited for momentum, and this little snapback right at an HVA line, and this is an HVA trade. And it's beautiful, Gary. It's a beautiful trade. But you got to give me the information. You got to tell me why. Otherwise, it's just, hey, guys, it's pretty big. Check it out. In these momentum trades, when they lose momentum, so let's turn this into a lesson real quick. If your momentum trade loses momentum, Gary, what's it likely to turn into with this look? This was one of the best lessons for me as I started taking momentum trades. If your large chart is screaming, right? If everything says up, you took the momentum trade, and guys, Gary nailed that lesson we talked about, being on the right side of those triggers. Once I get below, Gary, doesn't it make sense that it could potentially pull back to an area inside of favorable large triggers? Isn't that stop right in the path of the best high probability trend trade that you can take? I used to never notice this, and I would get stopped out right at a mid-band with the large chart saying go, go, go. Oh, and it sucks. So you have to ask yourself, if I'm in on momentum, am I going to exit with momentum? And if I'm going to hold for up here, the only logical stop is here where the market shouldn't go, which means that I still have to have risk on a trade. And that's that next level chart read as you hold. It's not I mean, hell, why would you give so much back? Get out below the 1-to-1s, be willing to re-enter with a reversal bar or something. Does that make sense? And I love this trade because I know what was happening on the other charts. And it's a beautiful trade, but there's the management side of it. And I'll be curious to see what happened. Because I love this trade. That's one of the trades that I take. Oh, and look what it did. Oh, not there. It ricocheted. And then it turned into a trend trade. I love it. And then it made it to the target. Did you make it? Hell yeah, you did. Nice job. Beautiful trade, Gary. And guys, this is using large chart terminations to take the first shot and then letting the large chart lead the way to get you to the target. That's pretty cool, guys. That's next level. Gary, this is awesome. The only chance of a problem was right here, but this turned into one of those momentum trades. Pull back with all the triggers through, and then that momentum died and it turned into the trend trade. I'm adding contracts here. Anything that I took off on the way up, I'm adding back on right here to get to that fib. What a great trade. Guys, this is next level. This is what you can expect to do when you're a chart reader. Gary's been with us a while. Rock star, Gary. And not beating you up, but man, that large chart was probably a big part of why you took this entry. Share that one. Because the 21 says don't do it. The 21 says 3 divergence is lower divergence. But the large chart, I guarantee, said, man, Gary, don't you miss this trade. Is anyone feeling smart for taking an exit at resistance with none of the triggers through? Jen? Did you decide to hold? Beautiful, Gary. No? Great job. Large chart was just past the purple 1-to-1s. 5-1 entered in the middle of the large triggers. Ian Mike, your rule says enter in the middle of the large triggers. Your rule doesn't say enter in an area inside of triggers? You want to see something cool? Why is language so important? I'm just going to write rule 3. I was an English lit major, so I'm kind of a word geek, but check it out. You're in at 66, right? So Mike, the rules-based entry is 56. That's $100 less risk. That's $100 more profit. Nice, Gary. And Gary, your patience on that long entry was awesome. The challenge, one of the challenges on this one, Mike, is that you're not running your synthetics over here. The only fibs that you have on your large chart are the large chart fibs, which makes it a little difficult. And I'm going to show you why. And guys, this is for everybody. If you're not running all 3 time frames on your large chart, let me find my picture here. Oh, that's what makes them synthetic, is when they show up there. I'll go through how to do it after this. Yeah, it is, Gary. So on your large chart, ladies and gentlemen, there are 3 time frames worth of fibs. There is the 5-1 chart fibs. There is the native 13-2 chart fibs. And then there are the 21, which is a higher time frame. So if you're looking at crude oil, the S&P, you're going to see a skinny line that doesn't project all the way to the right. That's from your 5-1. You're going to see a fat line that doesn't project all the way to the right. That's from your 21. And you're going to see a skinny line that does continue off through the gray, and that's native to the 13-2. Why is this important? Well, this is the way Nexgen sets up your large chart. And the rules are, do all caps, when price reaches a line on the large chart and triggers remain below, it's a termination condition. Everybody's comfortable with that rule, right? It's a termination condition. So when this comes into play is, dun, 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 dun. Here's my 5-1 chart line, and there it is on my large chart. So Mike, and you're cool, you're on sim and you're learning. I don't want you to panic. Stay in your trade. But that's a termination condition. Completely. But with this level of momentum into the fib, if you got paid here and you're like, you know what, the momentum is still amazing, and you take that great entry down here at 66, Mike, you're already up $160 instead of $60. But at least you know about the trouble, so it opens the door for you to manage a little aggressively. Maybe get paid right there at 73. Make sure that you're break even. Have these concessions in place. If I get a second lower divergence, I'll exit the trade or something like that. Does that make sense, Mike? So you're back to break even where you could have been taking $100 right at the area inside of favorable large triggers. And Mike, I don't think you understand how important these pictures are to get you where you want to be. Because from this one picture, we get to talk about synthetics. From this one picture, we get to talk about the perfect entry. From this one picture, we get to identify potential trouble and where you can get paid and get profits and stuff like that. And man, these work. So right click on your large chart and go to data series. And tick replay should be checked. And if it is, you should see those synthetics. And if it's checked but you don't see them, one of the things that you can do is right click and just reload all your historical data. Let NinjaTrader go back through there and kind of do a little fresh start and see if they show up. Because that's a lot of information. That's a lot of information to be doing without. There you go. I'm telling you guys, the classroom gets better every time you guys post a picture. The education gets better every time you guys share a chart. And I'll notice these things. I've had people show me their small chart, but without synthetic figure triggers. I'm like, man, you're giving up an advantage. And here's a cool lesson too. You guys may like this. We're getting towards the end and we're out of pictures, so I'm just going to go lessons. So guys, one of the concepts that we talk about, and the concept that sets you up for success on the large charts, one of those great looks, let me find it real quick in my library. I did a little video on it, and it's the idea of strong tops and bottoms. I take a lot of pictures, ladies and gentlemen, a lot of pictures. See if I can find it. Well, shoot dang. Hold on, I'm not giving up yet. Strong tops and bottoms for the new user. There we go. So it's the idea of strong tops and bottoms. And a strong top or bottom, guys, it's a termination condition that reverses the market. So when you get to resistance and none of the triggers break through and it reverses the market, this is a strong top. And a strong top is the precursor for like the highest probability trend trade short that you can take. And when it reaches Fibonacci support and the triggers stay above and it reverses the market, it's a strong bottom. So when this termination reverses the market, that's the precursor to like the highest probability trend trade that you can take. So when we talk about strong tops and bottoms, this mid-band was behaving as a termination condition and it reversed the market. So this strong bottom set up the highest probability trend trade and all that momentum cranked us all the way up to resistance. Guys, this is the best of the best. This is the one that you never want to miss. But then the second part of that is that if price just kind of reverses from nowhere, right? Kind of a pivot from nowhere, not from an area, not from one-to-ones, not from a divergence high. Guys, this is just a pivot. This is just an up and a down. Does that make sense, everybody? This is nothing more than a pivot. When this pivot comes from the middle of nowhere, this is where chart reading begins to create expectations. The midband is more likely to hold. This support is more likely to hold. When these triggers don't follow, it's more likely to hold. There's your gap theory. So we're starting with a pivot from nowhere, not a termination. It's reaching what is a termination condition. The triggers are way off in the distance. And then once it reverses it, it is a strong bottom. Cat jam. Open that lane. Meow. Love it. Have a good one, Morgan. So we start with a pivot from nowhere, and we say no shorts. And the termination confirms, man, no shorts yet. And then when it comes here and reverses and gets to the other side and creates momentum, you're like, oh, there's my trade. But here's a great expectation that you can create from a chart read. When a bad top reaches the midband and continues up, it's more likely to go to that next key area. And it's the idea of unfinished business. The buyers couldn't get there and the sellers tested the water, but the buyers finished the move quite often. And that's exactly what they did here. And now they're back in here. And this is a pattern that you will see a lot. There's a bad top and they push back to support. And there's a bad top and they push back to support. And there's a bad top because the triggers get through. And it comes almost back to the midband. And then when they finally reach the key area, that's where they get the big shove, but only back to support again. And off they go. And then the bad top and back to the midband, and they finish the move to resistance. So this is a chart read, bad top, right back to the midband. Even the termination to termination condition, and the long momentum continues up. So you'll start to see this. Doesn't make it, pulls back, doesn't make it, pulls back. Makes it, big deep retracement, and then it starts up again. So this little understanding, bad bottom, mid-band, back to the key areas, it begins to create expectation, guys, and it makes it easier for you guys to believe in these trades because of the termination, because of the reversal, because of all that good stuff. And here's your quick question mark. The perfect area inside of favorable large triggers, 79.56 to the right, are inside of the synthetics. And synthetics by definition are not large triggers, they are synthetics. Pedantic. Semantics? Pedantics? But trying to get words right. I love it. So Jen, thank you for this question. That's a large trigger, right? Pretty cool, right? That's it right here. It's still a large trigger. It's just been moved over to the 5-1. So anytime Nexgen moves a fib, a trigger, whatever, to a different time frame, the word we use to describe it is synthetic. So this fib right here, that is actually a 5-1 fib, would be considered synthetic. It's still a fib though, isn't it? We just call it synthetic. So this synthetic large trigger is still a large trigger. This synthetic fib is still a fib. Awesome, Mike. I love it when we have aha moments. So hold on, I'm not done with you yet, Jen. Don't you jump ship on me yet. So now I want to go back and I want to talk about I want to go back to this one real quick. Let me pull this picture up that we used earlier today. So when we're talking about entries, when we're talking about entries, we're talking about the absolute best of the best, Jen, being when price pulls back to the large and the synthetic, one on top of the other. What does that mean? That means that the large chart large triggers and the small chart large triggers are creating a correction point that's just, it's the same spot, right? Does that make sense? It's the exact same area. And then when you put something to bounce off of, holy kick ass. These are where the great trades come from. But the flip side, Jen, is that we expect price to come back to triggers, right? So when your large chart triggers are here, oops, sorry, and your small chart large triggers are here, Jen, I don't know which one it's going to come back to. I don't know if it's going to stop here at these one-to-ones, and I don't know if it's going to come down to the synthetics. So we use the term favorable large triggers. See how they're overlapping? The correction point is one on top of the other. And because they're overlapping, it's a smaller, whoops, that's not the right one. You can't see through that. Because they're overlapping, this is where I expect price to correct to. Does that make sense? And because I need an area, there's your window of opportunity. And where did that market bounce from? Remind me. Holy crap. Right there inside of favorable large triggers, which means, and watch this, let's carry the lesson out, Jim. And this is a good one. And this looks like the picture that I took for the slideshow. Here they're one on top of the other, right? The correction point is small. There's only one line. And that's exactly where we said the market was likely to bounce. But here I have two correction points. I've got a large trigger and a synthetic trigger. Hey Pete, welcome to Nexgen. But Jen, do you notice how I only have one line inside of a trigger? I only have one area for a bounce inside of a trigger. So logically, if I'm going to take this trade, I'm taking it from the line inside of triggers because honestly, that's what my rules tell me to do. Split triggers can suck, but if there's only one line and the rules are met, that's it. Awesome, you're welcome. Thanks for posting that. I say it every day and I mean it. You guys are going to ask me a question and force me to explain things differently. And then it's going to click and you're going to have this aha moment. And we don't see these moments in the beginning, right? Because everything is just coming at you and you're like, ah, terminations and momentum and oh my gosh, and it's crazy. No, ask a million times. You guys don't realize this. Let me show you something. This is my brother. We go through 175 messages every morning before I ever come to class. And most of it revolves around patterns and entries and bottoms and tops and all the different things. I ask questions every day, guys. And Paul, it's just going to hit you one day and it's going to be awesome. And for those of you that are brand new, I say this a lot. Stick it out. Make it through your demo. Keep it simple. And it really does have the potential to be easy if you allow it to be. If you're not looking for trades but rather advantages, it becomes easier. If you're taking simple concepts and letting those run your decisions rather than your emotions, it becomes simple. And the further you get out of simplicity, the longer it's going to take you to get to where you want to be. It really is. And it's just a fact of life with what we do. So focus on letting it be easy. So Jeffrey Dean, as you're in your first week here, let it be easy. There should be no doubt in anybody's mind. The woo is always wooing you. There should be no doubt if you've spent a week with me that you know exactly where the market's likely to continue. Now you just have to get enough repetitions to be able to catch it, right? And you have to make enough mistakes to learn how to avoid those mistakes. And you have to put the time in and do what you're doing. But I'm telling you right now, if you got in at 35, or even if you got in at 39, and you took that up to 74, guys, that's it. That's your day. Go surfing, go play golf, go do something other than sit and stare at a market. So it looks like we made it